All right, everything looking good. We are live. Let's go ahead and get this stream started. Welcome back to the channel for our Friday morning market wrap-up. It is 11 a.m. Eastern Standard Time. I am Crypto Trend Trader. It is March 4th, 2022. And today we're going to be taking a look at the markets. Obviously, quite a bit of volatility going on here. We are seeing some markets surging. Others are under heavy pressure. Obviously, crazy geopolitical events fueling much of this as inflation runs rampant and the conflict between Russia and Ukraine becomes even more uncertain. We're obviously seeing quite a bit of fear-mongering from the media as they are scaring people with their talks of nuclear war or nuclear power plants being seized and attacked, potentially blowing up. But let's just keep a calm and cool head and keep in mind that they don't actually care about anything but their clickbait views. So we should be a little bit hesitant to want to go to war and should be wanting to do anything possible to avoid this. So before we do get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. So go ahead and jump right in. So let's just get started. We'll run right down the line here. So you know what? Let's go ahead and start with the dollar today, DXY. So obviously we are seeing an aggressive move to the upside. Once again, we have been calling for it since the bottom back here, since we put in our cycle low. It is no secret that everyone has been extremely bearish on the dollar, but there are literally no signs, no reasons, nothing on the chart, on the technicals, or even on the fundamentals that would tell anyone with half a brain to be bearish on the DXY. So we are seeing, obviously, it is surging. It had crossed above the 200 exponential and simple on the daily back in August of 2021. We see we confirmed the 200 simple and 200 exponential slope to the upside. And since then, we have basically just been consolidating and going higher. And now we are seeing, what I refer to as a parabola, where essentially, in different areas and different cycles, different ways, we move away from the 200 exponential and simple. Here we're moving away from it in basically a diagonal straight line up and to the right. And then we're coming back at a, diagonal straight line down and to the right. And then up and to the right diagonal, kind of going sideways with a small pullback. And then again, we start to go slightly parabolic here and then immediately have like a V shape. This is a full-on parabola where we start to see the moves to the upside accelerating. And, you can tell because we see like that rounding shape and then it goes, essentially straight up. So that tells me that this is a very powerful move. This is a big portion of our fear trade right now. So as there's uncertainty in Canada because of regulations, as there's uncertainty in Europe because of war, food shortages, energy shortages, essentially it pushes people to the least risky of those assets, which obviously is the world reserve currency, which is the United States. So even though we have our own problems, we are very much clearly the, cleanest pair of underwear in the dirty laundry basket, so to speak. So obviously we are seeing the DXY surging to the upside. No surprise, we're nearing that $100 or 100 price target, I should say. But the speed of this move, the pace of this move, the velocity of this move is what is most aggressive about it, most important about it. Because when we see a move like this, while it's probably not sustainable in the short term, moves like this can continue on longer often than they should or have more aggressive moves than they should. And this is similar to what we're seeing in energy, what we're seeing in commodities in general. So obviously we have quite a bit of price action that has taken place around these levels previously. So we have, a peak here, and quite a bit of price action through here. We have a couple small peaks here, a couple peaks through here, and then we have this big old peak right there. So now if we look at this, from a non-biased perspective, we can see very clearly that the 200 exponentials on the daily are curved to the upside and, only accelerating away from them, telling us that not only are we, going to the upside, not only is this a bullish trend, but it's getting aggressively more bullish by the day. If we switch to a longer time frame on the weekly here, so again, now this chart is going back to the 1980s, 1985 this is on. We see only a couple times total on the weekly where we were bullish. Once right here, and then we failed and broke back down, but put in a higher low. And then we see a very aggressive period through here, which was our late 90s, early 2000s, where the dollar went parabolic and put in its first of the lower highs on the macro. And then again, we see what started back here in 2012 and is very much a bullish trend to the upside. We saw a little bit of time where we lost a trend, consolidated here, but once again, we put in a higher low. And now again, we have reclaimed the 200 exponential and simple, and we are aggressively accelerating away from those moving averages to the upside. So once again, we see there is very little resistance here, just a couple of small peaks. So as we bust through these areas, as we go higher, say for instance, once we get above 100, which is a nice round number, we have, 3 key peaks here along the way. But once we are above them, we have very little price action that has taken place on the DXY above those points. So we have less and less resistance that would hold us down. So in the event that we do break through those levels, then we really only have 2 very small peaks that lasted only for a couple months each, at which point in time, we're more likely than not going to break to the upside and potentially put in what will eventually turn into our first drive, our second drive, and then our third drive, of lower highs essentially. Now, if we switch over to the, and then looking at our momentum and indicator oscillators down here, we see the TJD TDMACD accelerating to the upside, blue slope above the 0 line, very aggressive. We see we were in the bullish control zone, came back down to the neutral zone, and now once again, we are accelerating back to the upside. Looks like we will get a hard buy signal and re-enter the bullish control zone shortly. And then just switching over to the monthly, this is obviously extremely, extremely bullish. We see, because this is 200 months before the 200 exponential or simple moving average is populated, we don't have data that will populate past here because it's only going back to 1985. But if we were to extend the 200 exponential and simple out to the past, we would probably have something like this. So when we crossed above the 200 exponential and simple somewhere around this range, and then we got this reversion to the mean kind of retest of them, because we assumed that they would look something like that. That basically was a pullback, and then we went parabolic afterwards and then put in our first macro lower high. So now that we know we're above the 200 exponential and simple, our first initial test as we got above them, we retested both the 200 exponential and simple here in 2018. We then moved up and put in a lower high. People got, once again, extremely, extremely bearish on the dollar, talking about it lose its reserve currency status. It was going to 0. The dollar was useless, blah, blah, blah. So then we came back down, retested the 200 exponential. We flipped over the 200 simple to the upside now, and the slope is accelerating to the upside. So we are moving away from that in aggressive fashion. So obviously, once again, on the monthly, we are at potential monthly resistance right now. 100 is the nice round number, and we would expect resistance there as well. But we know that we're only picking up steam as the 821 have crossed to the upside. We have uncertainty around the world in all kinds of other currencies, obviously, that are in compared to the dollar. And then obviously we have a hard buy coming out of the bearish control zone. We have entered the bullish control zone. Very powerful looking stochastics to the upside on the monthly. We're above the 0 line on the TJD TDMACD. We have only green histograms for month after month after month. And then obviously we have the blue slope line has confirmed to the upside right here. So once again, extremely, extremely bullish. The DXY is quite arguably the most bullish it has ever looked since the 1980s. So for all the people out there talking about the DXY is weak, it's going to 0, it's garbage, they don't have any idea what they're talking about. And we know obviously that this peak that corresponded with the 1985 era, that was leading into that. We were getting record levels of inflation. We had Paul Volcker hiking rates, etc. So this is not just a United States problem, like we were seeing back in the Great Depression. This is a world problem. So the speed, the velocity, the intensity of the move could be exponentially more, if we start to see hyperinflation or, other instability issues around the world. So, and then without getting too crazy here, obviously this chart is absolutely insane, but we have a high right here, we have a lower high right here, and then we have our target to the upside, which would potentially give us a move back up to like 109, obviously taking out these previous two highs, putting in a potential third lower high, and giving us the retest of that yellow channel resistance up here to the upside. So we know that we have hit some very key levels along the way already, but there's some definite potential for a continuation to the upside. We know also that we have seen various high macro peaks with these yellow time cycle analysis lines. So we know that, according to those, we are likely to put in at least some sort of peak, if it's not the absolute peak, somewhere around August of 2024. So the likelihood of this trend playing out over the next, year and a half and having an aggressive, a 10% move in the DXY is very substantial, because it's essentially the strength of the dollar compared to the other basket of currencies going up by 10%. So, imagine being able to buy 10% more goods being imported to your country. And that also lines up with the macro idea that, the world will need dollars to settle their dollar denominated debt before they can ever get off the system. So obviously that's going to lead to higher trade deficits. The stronger the dollar is, the more imports people will be able to purchase, because they'll be able to get 10% more. So if right now we're running, $1 trillion deficit, let's call it 110 trillion, maybe more, depending what happens in other countries, as their currencies may even lose more value in comparison to the dollar, etc. So we will see what happens. People talking about, the dollar is dead, it's losing its buying power. Compared to assets, sure, it's a lot of assets are going parabolic to the upside. So it is in fact losing its dollar, or its buying power. But compared to other currencies, if you figure out, where do I want to put my money? Where do I want my investments to be? Do I want them to be, in my case, I'm in the United States, so do I want domestic investments, things denominated in dollars, or do I want foreign investments when the basket of currencies that I may be purchasing these investments in are in other currencies that are weakening compared to the dollar? And that's important, because if I buy an asset and it does nothing, but the currency appreciates or depreciates by 10%, I either gain if it appreciated 10% or lose if it depreciated by 10%. So if I'm buying an asset in a country where their currency is strengthening, that's good for me, because regardless of what the asset price does, I gain. But in opposite way, if we say, for instance, we're buying assets in Russia right now, and the ruble is dropping by 30%, 40%, 50%, regardless of what my investment does, if it does absolutely nothing at all, the depreciation in the currency, or loss of value in the currency, makes my investment lose value. So you want to take into account, Forex or relative strength of these currencies or this basket in comparison to wherever you're making your investment at. So if oil is strong, or a various other commodity is strong, coffee or, whatever I'm looking at, and there's not some sort of geopolitical risk that's putting excess downward pressure on that specific commodity, for, let's say, so, coffee or oil or wheat or whatever it is you're thinking about, that could be a double bonus, because the currency could be appreciating in value while the underlying asset that you're investing in appreciates in value, or land, or whatever it is. But if there's geopolitical risk, say you want to invest in oil, but then you invest in Russian oil, obviously now, regardless of what oil does, there's a downward pressure from Russia, because people don't want to be affiliated with them because of potential war crimes or whatever their reasoning is, without getting into too much political stuff. So there's geopolitical risk on top of, potential commodity risk. So vice versa, if we can find a currency that is strengthening, say for instance the DXY, and then we can find a asset that is strengthening as well, we get the double bonus. Because say for instance, real estate, let's say The real estate chart is strong and going to the upside. Real estate's appreciating in value. Also, the DXY is appreciating in value. So saying if I was going to buy real estate, would I want to say buy it in, England or Canada, or would I rather buy it in the United States? So the DXY chart is telling us we would rather purchase items in that sector inside of the United States because the dollar is strengthening in comparison to those other assets. And then regardless of that, we can look at the real estate chart and say, okay, now real estate in this country is also strengthening. So we have potentially a double tailwind for our investment, as opposed to if we buy into a country that is weakening currency, but we buy into a market that is appreciating. Say the currency weakens by 10%, but the asset goes up by 10%, we essentially end up break even with buying power. And then, obviously we can get a double to the downside as well. If you were to invest in an asset and then it turns against you, and then you do it in a currency that loses its value, you can get, double destroyed. And that's how you really lose buying power. So, but that is the DXY. Again, people are very biased. I understand that a lot of international people don't like the United States or don't like the idea of the dollar, or people, essentially printing money and then buying other people's stuff. I get it. A lot of that is just something that happens when you're the world reserve currency, because people need dollars. So part of the deal, part of the social construct is you have to import goods because you have to export dollars. The world needs your dollars. So there's liquidity. So you have to export your manufacturing to other places. Therefore, you're using your money to buy other people's stuff. It sucks, but that's how world reserve currency status works. We've seen it through history, and it's very common. It's part of the system. So if you don't like the system, change the system, but don't make poor business decisions based on it. And just a reminder, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. And make sure you smash up that like button in the chat. What's up, Asotos? Good to see you, brother. Appreciate you showing up today. Let me know what country you guys are in. I know we have an international community. I know we have, quite a bit of diversity in the group and in the community. So always curious to hear where you're at. You don't have to give explicit details like your GPS location, but just curious what country you are in, just so the chat can kind of get an idea as well, how diverse this community is. So next, taking a look at the TNX. So it is important here, too, that we pay attention to what's going on here. So Jay Powell has spoken twice now in front of Congress and basically been, questioned by them. A lot of them are cartoon characters, asking questions about global warming and climate change and flat earth and all kinds of other ridiculous things that don't matter right now. Jay Powell, what are you going to do about ethnic diversity within the community of, blah, blah, blah. And he's like, well, I work for the central bank, so we don't do anything that has anything to do with that. So next question. Very ridiculous. Everybody just gets up there and kind of parades around their BS political agenda. If you really gave a damn about anyone, whether it was your constituents, anyone in the country or around the world, you would be asking about, monetary policy of the Federal Reserve. You would be asking about inflation, what they're actually going to do about it. Instead, they're asking cartoon questions, just trying to virtue signal. They really don't give a damn. All they care about is their money and their agenda, so that they can basically take their bribes or get out of their positions and, take some position at some ridiculous corporation for some ridiculous salary for, basically completing that agenda while they were politicians. The corruption is absolutely disgusting and makes me sick. That being said, so what's happening here? Jay Powell is basically spelling out the situation to the markets. He basically got up there and literally said, this is what we're doing in 10 days from now. We have obviously the meeting. They're going to come out afterwards and Jay Powell will give a speech and they will say what the Fed has decided to do. And he basically said ahead of time, look, we're going to hike by 25 basis points, 0.25%. So the Fed funds rate is basically going to go from 0 to 0.25%, while inflation rages at 7%. So they retired the transitory word, but they're still up there. Powell is still up there saying, we think by the end of the year, inflation is going to come down. Well, anytime you're looking at year over year numbers, only two things can happen. It can either go down compared to the last year, or it can go up compared to the last year. So if inflation, say a loaf of bread was $1, and then inflation rages and a loaf of bread goes to $1.25. Okay, but the CPI is saying it's inflation 7%, but obviously bread has gone up substantially more. It's gone up 25%. But the basket has only gone up by 7%. So then Powell gets up there and says, look, we think inflation is transitory. It's not going to continue to accelerate at this rate. Bread's not going to go back down to $1, but it's not going to go up another 25 cents next year, a year from now. So if bread went from $1 to $1.25, it went up 25%. So then he's saying by the end of the year, this year, he's like, bread's going to still cost more money. It's never going to go back down to $1. He's like, but it's not going to be $1.50. It's probably going to be, $1.40. So that's the inflation is transitory. We still have massive amount of inflation, but it's accelerating at a slower pace. And then the year after that, maybe bread only goes from $1.40 to $1.50. So it went up 25 cents the first year, then it went up another 15 cents, then it went up another 10 cents, and Jay Powell is like, oh, look, it's great. See, inflation is coming down. Not the price of things, not the cost to buy those things, but the speed at which the price goes up. So actual inflation that scares Jay Powell, and I'm not saying I agree with the way this moron is thinking, but the actual way that they're looking at inflation is the rate of acceleration. So if it continues to accelerate at a faster rate, it starts to go parabolic like we were discussing. That's what they're afraid of. It gets out of control. They don't give a damn about it going up. They love inflation. People don't realize this, and they act like we have the same problem as the Federal Reserve does. The Federal Reserve does not have the same problem we do. What is a problem for regular people, and I say we, and it's, some people don't have nearly as much of a problem. If you're in a lower tax bracket, if you're making less money, if you're spending more of your money on necessities like fuel, housing, and food, you have a really big problem right now. If you are comfortable and you're spending only 10% of your annual income on food, housing, and fuel, it's probably not that big of a deal to you. Because sure, that 10% might have gone up by another 10%, but what is it? Now it's 11% of your net income, as where somebody that's spending 75% of their net income on housing, food, and gasoline, they went from spending 75% of their net income to now spending another 10%, so 82%. So now the most important thing is if you go from 75% to 82%, you're like, oh, it only went up by 10%. But previously you only had 25% of your total income as disposable. So if you went from 75 to 82 and you had only 25% of your total disposable, you now lose from 75 to 82. Now you only have 18% disposable. So you had 25% disposable. Now you have 18% disposable. So you have lost not 10%. You have lost 25% of your disposable income. So that is why it hits so much harder on people with higher amounts of their total income or net income or however you want to calculate it going into these goods. So what they say is 7%, probably your feeling is 10% or 15% or 25%. But when it translates to actual buying power, disposable income, money you can spend on other things, or your actual ability to live a comfortable life, it's exponentially more because it's a higher portion of your total amount of money. Because if you make $1,000 a week, and before you had $250 you could spend on other stuff after you bought your food, paid your rent, and paid for your gas. You had $250 you could spend before, and now it goes up by that 10%, but now really you only have $180. So you lost $70 worth of your $250. So you're going to feel that a lot more than when they tell you inflation's at 7%. And that's why people are struggling. That's why what Jay Powell is doing right now is absolutely criminal. That's why the Federal Reserve is, total trash. Because what they're doing, why they're so excited is this massive amount of inflation that's taking place is helping them to essentially whittle away at their ridiculous debts. Because if they can inflate the dollar and, take away the buying power, not only are they loaded up with assets, all these people are crooked criminals that got in trouble for insider trading. And I'm talking about all central bankers, not just the Federal Reserve here. they're benefiting exponentially. These are all rich people with millions, tens of millions, hundreds of millions of dollars in assets that are inflating faster than the buying power of the currency is deflating. So they're all getting richer while the slaves, the peasants, the regular people, the middle class in particular, are getting much, much poorer. And then in the meantime, they are essentially inflating away the debt, the deficits, all this excess spending, all this excess money that they're wasting. So that's why this is so important. So what Jay Powell did was he came out and, basically serviced the markets, serviced the people. Anyone that was afraid of a 50 basis point hike and instability in the markets and everything, Powell came out and said, look, I don't even care about inflation. I'm talking like I care about inflation. I'm acting like I care about inflation. I'm going to do something about inflation. And you know what I'm going to do to curb inflation, to stop it? He's like, I'm going to aggressively show my power, show my hand, and I'm going to raise Fed funds rate by 25 basis points, 0.25%. And then you know what we're going to do after that? We're going to wait and we're going to see what happens. And then you know what we're going to do? We're probably going to do another 25 basis point hike. I know. It sounds crazy. We're not going to go on autopilot. We're going to see what happens with the economy. We're going to see what happens with the market. Okay? But if we got to get even more aggressive, I'll do it. I'll get more aggressive if I have to. But we're not going to do it without reason. So he basically is literally saying, we're not going to do anything. Because there's literally no corporation, there is no one in existence that is going to change the way that they are managing money, the way they are treating money, loans, businesses. Nothing will change based on a 25 basis point hike. There's no one out there that says, wow, right now we're getting money for free, and soon we're going to have to pay 0.25% interest on that money. And that just changes everything. We don't even want that money anymore if we're going to have to pay 0.25% for it. The same way that if you were going to get a mortgage, let's say, and the mortgage was going to be at 3%, and then all of a sudden it was like, well, look, things are going crazy. Jay Powell's getting super aggressive. He's going to combat this inflation. He's not having any of it. So look, it's going to get bad here for a minute, all right? And you know what's going to happen? That rate on that mortgage you wanted to get, it's going up. It's going to be, I know, brace yourself, sit down. You need something to hold on to, because it's going to go it's not going to be 3% like we talked about. It's going to be 3.25%. I know. It's crazy. I know that extra 0.25, that 25 basis points might break the, oh, you don't care? You don't give a shit? Oh, okay, great. Well, let's do it then. Here's the house. Boom. I mean, that's what's going to happen. If inflation is raging at 7% minimum based on the CPI, and you're talking about increasing the cost of money by 0.25%, no one is going to give a damn. No one is going to give a damn. Because if you're getting money at 0.25% and inflation is 7%, let's just say you buy a house with it and the house is only going up in value by 7% a year. The loan is getting cheaper and cheaper because you're paying it back with less valuable money in the future. So it's not going to change anything. It's not going to make people feel better. They're not going to stop going out and rushing to buy everything they can because they're afraid it's going to cost more in the future. This is literally what they want. It's perfect. They're jawboning, pretending like they give a damn, and they honestly do not. So as soon as that happened, we obviously saw a pretty aggressive sell-off right here. You know, this was our push down. This was our push back up. And then Powell was talking, and people are like, is he serious? There's no way. Is he this much of a moron? No, well, he's saying it. I believe him. And now we're seeing an aggressive sell-off. People are running towards bonds, for safety. But as far as I'm concerned, this is just a retest of the breakdown right here. I do not think for 1 second that this is going to continue on. The market has an initial reaction and says, oh, thank God he's not going to aggressively raise rates. And then the market's going to say, wait a minute, this is unhealthy. This is really bad. We actually would rather he come out and say he's going to at least be aggressive and then believe that he's going to do it. The Fed is literally losing all credibility as we speak right now. Losing all credibility. I mean, it's atrocious what they're doing. Absolutely atrocious. So we're seeing U.S. oil obviously has broken out of our ascending broadening wedge. We are seeing that move take place to the upside right here. Obviously pushed up to the key levels. We hit the 114 price target. Finally, it actually went up. WTI crude, U.S. oil up to our target was 114. We hit the 114 target. We sold off a little bit, kind of pushed back up. Obviously, the fear with Russia, being a massive energy oil supplier is causing prices to skyrocket. All the various sanctions or whatever don't matter, because if you say, okay, we're going to sanction Russia, but we're not going to sanction energy because we don't want the price of energy to go up. And then everybody else is like, well, wait a minute. I don't want Russian oil. That looks bad on my company. People are going to post it up all over the internet and say, this company is buying Russian oil. So then what's going to happen? The internet's going to attack them. They're going to scream at this company. They're going to talk about how terrible this company is. This company's trash. They're buying Russian oil. They're getting oil from Russia. Like, cancel them. Cancel this company. And then the internet goes crazy. The whole world, hundreds of millions of people or billions of people start attacking them, posting up on their pages, calling all their phone lines. You crooked SOBs. I can't believe you're buying Russian oil. You murderers. And everybody attacks them. And now, the stock starts to crater for that company. And then, God forbid, actual sanctions go in on energy. And then now the whole world hates you. Your community hates you. Your investors are losing money. Your job as a company is to protect shareholder value. So why in God's name would you ever even consider, in today's cancel culture, crazy ass world, taking Russian oil? So sure, you didn't sanction Russian oil. You didn't sanction energy from Russia. Sure, because you don't want to upset the supply chain. You don't want to make prices go up. But you did. But you did. But you did. So you don't have to actually do it to have the effects of it. So I would expect these things to continue going parabolic. We've been talking about an energy spike for a while. Energy has been weak for decades. We've been talking about the energy spike and how important the energy spike was. And once we see the energy spike, don't immediately get bearish, but we know that every time in history when we have an energy spike, it is the final nail in the coffin. It is the fourth horseman of the apocalypse that leads to the demise of the world markets, of the world economy. It will absolutely crush growth. It will crush global GDP and absolutely send the entire world into a recession, depression, hyperinflation, global instability. So, you want to be afraid of something, be afraid of the energy spike, because this is real shit right here. And this, we've been talking about it now for months, and now we knew that was basically going to be the catalyst for what amounted to a recession/depression. The other three horsemen of the apocalypse, obviously slowing in the semiconductor space, slowing in global transportation space, and then, finally the yield curve inversion. So we can talk about the yield curve inversion. I'll actually, I'll show you guys how to do the chart that I use for the yield curve inversion, because I've had quite a few people asking about that as well. So we'll do that a little later in the stream. But we're going to keep on moving through here. Obviously, oil continuing to strengthen to the upside. Now, let me make myself angry with the oil chart for a second. All right, so let's take a look at this and pay attention on the macro, what we're looking at. So we have from our top right here, this was the all-time high in oil from 2008. And then we obviously went, negative based on futures, et cetera, whatever. So we're just going from around that area of the close, the spike, instead of just going from the crazy wick that, basically goes so deep into the earth that it pokes out the other end. So we have a resistance line. We broke through that resistance line. We got back on top of the 200 exponential and simple. We have moved up now to the 886, which was 3 key points of resistance, arguably 4 right here. After that, it's literally free sailing from here. So if we look back here at this period in time, there are literally 4 months, 4 candles, 2 to the upside and 2 to the downside, but 4 months worth of price action ever in all the history and all the existence of the entire world and everything in it. There are 4 single candles right here where price action took place or even did anything on top of this 886. So we're 4 candles away from a blue sky breakout on oil prices. So, you think oil's expensive now, you think energy's expensive now. Well, just wait, because if we get up to the new all-time high, if we hit this measure move of the, Adam and Eve bottoming pattern right here, after breaking through this resistance, after aggressively moving to the upside, 200 exponential, 200 simple, both angled to the upside, everything telling us that this is not even close to over yet. Even if we cool down for a little bit and we get, the new Iran deal and they release a couple million barrels of oil and everything cools back off and this green energy agenda and lack of capital investment, the misallocation of capital towards a necessity for humankind's existence, power and energy, is going to now bite us in the ass. So all these, green, earth, hippie loving, moron people that are like, we need to cut off energy, we need clean energy, and we need to just power everything with the sun and the wind because Mother Earth needs it. Okay, is it good for Mother Earth and the planet and humankind if we don't have the energy that we use to like keep people warm or give them electricity or create food for them or help to elevate people out of poverty? Because that's what energy does. That's what energy does. Energy helps people to have a more comfortable, a better, more civilized, functioning life with more nutrients, more, intelligence. It helps humankind to move forward. So when we take that away, it only reasons to say that we're taking a step back in humankind. So for all the people that are like, we got to get rid of oil because the carbon and the bad, it's bad. Those people are morons. They're stupid, stupid people who have no brains. Okay? Because you can't take something like energy away without replacing it with something else, or humankind as a whole suffers. And you know who doesn't suffer? The people with the yachts, the people on top, the people with millions or hundreds of millions or billions of dollars. Those people are going to be okay if they have to pay a little more for the gas for their yacht. It's going to be the poor people, the people that are clawing their way out of poverty, the people in third world countries who finally have electricity for the first time or are finally able to feed their family comfortably or, start moving their way out of the bottom bracket of society. Those are the people that suffer. So this right here, it sucks for a lot of us, but, if you're watching the stream right now, you're probably not going to feel it as bad as somebody on the bottom rung of the ladder. And it's very, very unfortunate. And if this doesn't make you sad, if this doesn't make you mad at the horrible leadership that we have throughout the world, I honestly don't even know what to say. I feel like it does make you mad. It makes people mad when they fill up their car and it costs an extra $25 or $50 or $100. It makes people mad when they have to pay their bill, but it doesn't really affect your way of life the same way that it does those people that are, basically clawing their way out of poverty. And it's a goddamn shame is what it is. But anyway, that being said, and then on top of that, what is the answer? Well, the answer is probably nuclear. That's probably the best thing. And then on top of that, now we have, Putin basically seizing a nuclear power plant. He's not going to blow up the power plant. He's not a moron. You don't go over to your neighbor's house and light it on fire. He's not dumb. He's not going to walk to his neighbor's house that's 10 feet away from his house and then light it on fire and then it starts catching fire, it's in a giant blaze, and then he's sitting there laughing, and then the wind blows and it lights his house on fire. No, he's not a moron. He's not going to blow up a nuclear power plant right next to his country and suffer the consequences. He's taking the nuclear power plant because it's a strategic move to seize the energy, and then now these people don't have nuclear energy. That provides a ton of energy to Europe, not just to Ukraine. So now he controls that. That's a strategic plan. So oil prices are going through the roof. What does Putin have? A shitload of oil. And so prices are going through the roof on oil, and then he takes away your other way of getting energy. Now he has your nuclear power plant. So what does that do? Causes oil to go up more because now people can't get the nuclear power. They have to pay you for your oil. So this dude is a tactician, and he's doing exactly what you would do as a ruthless dictator or leader that is being tactical, and no one's going to do anything about it. They can't do anything about it. So trying to warmonger and say, like the media is doing, oh, he's going to blow up this nuclear power plant. He's a madman. He's crazy. He's psycho. He's lost his goddamn mind. He's going to set off nukes. He's going to blow up nuclear power plants. All these people are stupid, and literally fact checkers should jump on, fact check them, and get them away from anyone, because all they're doing is spreading bullshit propaganda and trying to warmonger. Okay, the best case scenario is Putin takes Ukraine, takes it under his control. I'm sorry for the Ukrainian people. It sucks. But then we don't go into nuclear war. That's the best case scenario. Okay. The worst case scenario is Putin pisses everybody off. They start beating the war drums. And then we go into a nuclear World War III. That's worst case scenario. And then there's a bunch of stuff in between that's bad and lots of people die. And, this happens, that happens, whatever. But the best case scenario is Putin accomplishes his agenda and then just lets off a little bit, okay? There's a bunch of bloody mess in between, a big gray area in between, but we don't want to go to the other end of the spectrum, which is nuclear war. So the best case scenario is NATO just stays the hell out of it, and then Putin does what he's going to do, and then we go about our business. And people are like, yeah, you just love Putin. Well, no, I love humanity, and I don't want there to be nuclear war. So that's what I'm talking about. But, people don't think like that. So crude oil going to continue to spike, energy going to continue to spike, costs going to continue to go through the roof, inflation going to continue to go through the roof. We have done nothing to correct the supply chains. They are still in the exact same shape, probably worse as energy goes up. We know that the cost of energy is the cost of goods, the cost of doing business. So if we know that interest rates is the cost of borrowing money to fund ventures, we know that the oil, the energy, that's the cost of doing actual business. So if you want to build something, you want to make something, you want to transport something across the ocean, you want to do literally anything at all, you need energy for it. So as energy prices continue to spike, it costs more to do everything. And we all know that the best cure for higher prices is higher prices. Eventually, it's no longer functional for businesses to do business because it's too expensive for them. So they just stop, or they cut back, or they just close their doors, and that's it. So then people lose their jobs, prices go through the roof. So people, as a consumer, you can't consume as much goods because you have to spend more of your money on the energy to stay warm, or turn your lights on, or do whatever it is you need to do, drive to work, or whatever you're doing, run your own little small business. So your consumption goes down. So the price in oil, the cost of electricity, whatever it is, the coal, whatever energy that's spiking right now, not to mention food prices, grain, corn, whatever, that all goes up. Your consumption goes down. So world GDP goes down substantially because people can't afford to spend the money on the things that they would normally spend the money on because more of it is going into their energy. So this is not good. And it's every time we see a blow off top in energy is right before a massive crisis. We saw one in 2000, we saw one in 2008, and we have multiple examples we have pointed out before that. And every time it was followed by a global recession or, potentially depression level event. So expect that. When does it happen? Well, probably in less than a year, maybe 6 months. Who knows? Hard to time these things, but we know it's happening. It's going to happen. So we see the VIX here, volatility on the S&P 500. Let's look at the macro chart. We have not looked at this for a while. So this is what the VIX does. It oscillates within a range. The VIX will never trend like normal charts start in the bottom left and go to the up and to the right. They only just go up over time, except for horrible, trashy companies or useless cryptocurrencies or something like that. They usually have like a blow off top and then just go to zero. So with this just oscillates within a range. So we know when we're in the bottom range here in green, that's a key area. We know when we're in the top range here in red, that's a key area. So when we're up in the red here, it means probably whatever is happening, there's massive amount of volatility and the stock market is crashing. And we know when we're down here in green, there's absolute complacency. There's almost no volatility and people are the most comfortable. Within that range, we've been inside this descending channel, operating inside this channel for a month after the COVID explosion. And obviously, what did this peak correspond with? Well, it corresponded with, massive sell-off in asset prices in the S&P, or, we're looking at this as a broad range of, the U.S. markets. So obviously, since then, we've been in this descending channel. We now have broken out of the descending channel. We have our first monthly close outside of it, an open and a close. And now here we are continuing to the upside. So volatility is going to the upside, now trending inside of a smaller channel here in white. So now let's go back to our shorter time frame. So this is bullish. Volatility is bullish. So this tells us that going into the future, volatility is going to continue to increase. So what does that tell us? Well, probably while we were going to see spikes where the market is bad as we go up, and then spikes where the market does good when we go down, and then it does bad, we're going to continue to see higher lows and higher highs, which tells us as volatility increases, prices probably go down. So anyone calling for the bottom of the market while the VIX is literally closing at highs, like new highs for years, well, not years, but the last year, we've basically been trending down and now we're trending up and we're moving towards this red zone, which is basically telling us, we've only entered this zone a couple times in the last 20 plus years. So we know when we get up there, there's extreme volatility in the markets and probably some sort of crash or something like that taking place. So as we approach this level, as we get closer and closer to it, then we can start looking for potential bottoms in the market. Maybe we come up here, maybe things go back to normal and relax and everything's gravy, and then the market stops selling off, and then we can come back down here, everything cools off. There's no more global tensions. There's no more crazy government overreach. There's no more potential World War III. Sure, maybe. Does it seem like we're trending more towards that and just going back to like normal, and all the wine moms can just put their kids back in school, take their Xanaxes, and just go about their business, go back to zombie mode? Or does it seem like things are escalating and there's just more crazy shit that we're hearing about like every single day? Because I think probably the second one. I mean, the wine mom's still taking their Xanax. They're still drinking their wine, but now they have little kids running around. They're worried about, do they have to mask? Don't they mask? Oh, I need this, that, and the other. Like, let's be real here. Things are escalating, and that's why we're seeing this volatility continuing to trend to the upside. So this, to me, tells me now's probably not the best time to be like, I'm all in on the markets. I'm throwing all my money at the markets. I'm calling the bottom. It's official. We're at the bottom. Because I keep hearing that from people, but I'm like, well, why? Where are you calling the bottom? Oh, because something's down so much? It's easy to go down 50% on a stock and then go down another 50%, because when you look at it from the top, it's only down 75%. And there's a lot of assets that are already down 75%. So if they're down 75% and you're like, well, it's already down 75%, it can't go lower, bro. And you're like, really? I bet it loses another 50%. So it can keep getting cut in half and cut in half and cut in half. So we don't want to just try to pick these bottoms right now without anything telling us that we're potentially at these bottoms. So volatility only increasing, trending to the upside. Let me jump over here in the comments. I see you guys going crazy. Glad to see. All right, so let's list off these international places. Asoto says Greece. Good to see you, brother. Peter Gerd, what's up, my man? UK. Okay, Milligan says Germany. All right, okay. Got some Germany. Trader Billy J, good to see you, brother. Holland. Okay. M. Hoff says United States. All right. Me too, brother. Peter Gerd says, I see a rush into the dollar stable coins. Yeah, oh, for sure, man. For sure. Digital dollar is much easier for people in other countries to get, Tether or USD coin or whatever you can get. Obviously, certain areas can only have accessibility to certain things. But if they're pegged to, quote unquote, the dollar or dollar denominated debt or whatever their, probably fake white paper says, at least it's better than, like the lira or the ruble or one of these ones that's like hyperinflating. Craig Mans says, hey, crypto trend trader, I'm in the UK. Definitely don't buy real estate here. It rains a lot. Yeah, man. I know. I've been to the UK. It's definitely not the best weather. That's a fact. But so we got a UK too. Trader Billy says, love dollars, man. Gaining more euros right now. Yeah, exactly, brother. Exactly. Arbitraging the dollar strength by gaining other things. Because look, all the people that were saying the dollar is weak, it's garbage, sell your dollars, buy anything, invest in other countries, buy stuff in other places because the United States is garbage, they don't make anything, and the record trade deficit, and your dollars are losing value every single day, and you're getting killed by 7%, and they're printing so many dollars, and you're not going to buy anything in the future because you're going to be so poor. So how long have I been bullish on the dollar for? Probably like about a year now or something like that, since I called the double bottom perfectly to a T, and we've been going parabolic since then. So those dollars, okay, they lost 7% because of inflation, or 10%, or 15%, depending what I want to buy. Sure, okay, they did. They lost 7 or 10 or 15% if I want to buy certain things. But how many different assets have gone down by over 7 or 10 or 15%? How many stocks have gone down by 75% or 50% or 35%? A lot. Almost all of them. Almost all of the stock market has gone down more than that. How many cryptocurrencies are down right now more than 7%? So did I lose buying power with all my dollars, or did I gain buying power? So say I wanted to invest in Russia, and I said, wait a minute, the DXY looks strong, even though the Russian ruble is not in the basket of currencies. Now say I want to invest in Russia. Can I get more Russian assets, or can I get less Russian assets? Say I want to invest in one of these other markets, Turkey. Can I get more Turkish goods or less Turkish goods with my dollars that are going parabolic while the Turkish lira, goes to zero in the fastest we've ever seen in history? Don't listen to these mainstream people because they are brain dead. They have no idea what they're talking about. It's just like Cathie Wood. I don't hate Cathie Wood. I don't hate the idea of innovation and the future and things changing. I don't hate that stuff. But I understand timing is the most important thing. If I tell you that someone came to the future, a viable source came to me from the future and said, look, okay, sun's going to explode and it's going to wipe out humanity. It's going to take out the earth. It's going to blow it up. That's it. It's a wrap. And I say, oh my God, are you sure? And they're like, yes, 100%. And I'm like, okay, I trust you. I believe you. Sun's going to wipe out humanity. It's going to blow up and destroy the earth completely. And then I base my decisions on that, even though it's true. It's a fact. It's definitely going to happen. And that's correct. Assume that we know that for sure. We know the future. It's definitely going to happen. If I base my decisions on that without taking into account time, how good are my decisions going to be? So I'm going to just go out and do a bunch of drugs and, be promiscuous and waste my money and not invest and not worry about my future. And I'm going to just make all these decisions based on the fact that I know the world is going to end. But I don't know when the world is going to end. I didn't get a date. I didn't get an idea. And then I come to find I blew all my money and make all these poor decisions. I'm all scratchy downstairs because I made poor decisions, with, trusted a woman who wasn't clean, whatever situation is, okay? I make all these terrible decisions. I waste all my money. Now I'm a crackhead, with some downstairs issues and I have no money and I'm living on the streets and I'm like, oh man, good thing I did all that. Got to enjoy life before the world ends. And then like that person comes back and tells me again, hey man, the world's going to end. And I'm like, yeah, I know, man. I did all this and that. And they're like, oh, that's great. It's going to happen in 10,000 years. And you're like, wait, what? 10,000 years? But I already blew all my money and I already got, STDs that I can't get rid of. And I'm addicted to crack. And they're like, yeah, I should have told you that. It's definitely a big factor. So the timing is everything. Sure, you got on top of the trend. The world's going to end and you made your decisions based on that. But the timing is so far off, it doesn't matter. So all these people are saying US dollar is going to lose its reserve status. Yes, I agree. The US dollar will not indefinitely be the world reserve currency going into the future. I agree 100%. I can say with absolute certainty that sometime in the future, the dollar will not be the only world reserve currency, maybe not even a world reserve currency. I completely agree. Okay. But do I want to bet that it's going to happen in the next 1, 3, 5 years after hundreds of years, 100 years, whatever? No, because the timing is everything. And that's why, I don't hate Cathie Wood. I'm happy for her. Her story is motivating. Sure. Great for you. Single mom, builds up a hedge fund. Like, that's great. Billions of dollars of people's money trusted. That's awesome. But you're not looking at the timing. You're investing on innovation. You want them to cure cancer using genomics. You want them to, have cars that drive around, robo-taxis and all. It's great. I love the idea of the future. But we're not betting on that happening in the next 2 to 5 years. Okay, it will happen eventually. Sure, we'll probably have robo-taxis in the future. We will probably have, a genomics revolution sometime in the future. We will probably have disruptive innovation sometime in the future. We will probably have a future where we don't need oil the same way we do now because we have, cold fusion or something like that. Sure, I totally agree. Or solar energy or wind energy or whatever. But let's not bet against the things that we have right now that are working without taking into account the time, because that's a huge, huge factor. You could be right, but if you're early, you're still wrong. Peter Gerd says, I believe the square earth theory. Oh, 100%. I mean, it's a fact. I believe it until someone can show me otherwise. Square earth theory. Soto says, I heard about an hour and didn't hear a thing about supply chain and oil. I heard about an hour and didn't hear a thing about supply chain and oil. I'm not sure what you're saying. I'm confused. Peter Gerd says, they're terrified by deflation. 100%. They're fighting deflation. They act like they're fighting inflation, but they're not. They're fighting deflation. They want inflation. That's that Powell blowjob. He's been waiting for it for years. He's finally got it. He's not going to go out of his way to stop it right now after waiting, a decade for it. But there was a question about California sinking due to climate change. Yeah, of course. Of course there was. Yeah, I mean, these people are stupid. You're like, that's what you're worried about? You're worried about California? The world would be better off if California sunk due to climate change. That's a good thing. We should all be voting for that. Peter Gerd, time to get yourself a electric car. Yeah, for sure. I mean, and is this part of their agenda? Drive up oil prices to where no one can afford oil, so everybody has to ride a bicycle or a moped or drive an electric car. UniQ says Friday stream. Good to see you, brother. Dab right back at you. Soto says Powell. Yeah, for sure, man. All right, so let's jump back in, take a look at these markets. So let's look at the stock market. We'll take a look at crypto here shortly. Talk about what's going on, what's been going on, and what we expect to continue to go on in the future. So Dow Jones. So we look at Dow Jones. What do we see? We see more weakness in the Dow. So we continue to have a high, a low, a lower high, a lower low. And now is this going to be our lower high? Are we going to go back up here slightly higher and retest? We don't know yet. But we know for a fact right now, we know when we look at this chart, for a fact, without any doubt, we know that we entered into a bull market in the Dow Jones based on the most conservative way possible, which is the slope of the 200 simple and the 200 exponential. We know for sure we were back in a bull market in November 2020 at 26,851 Dow. And then we see just from then, we just see a parabolic uptrend, just absolute beautiful, everything going up, another 10,000 points on the Dow, 40%. From that point, we have come down here now, and we have seen the opposite take place. We have broken down below the 200 simple. We have broken down below the 200 exponential. And then we see a negative slope on both those. The 200 exponential is red. 200 simple is pink. That is a bear trend, a bear market, based on the way I determine it, which you can do that or not to do that. You can do whatever you want to do. And obviously it's not financial advice, but you should be able to write down on a piece of paper in 1 to 3 sentences how you define a bear market. So, take a notepad out, think about it for a minute, and then write down what is the definition of a bear market. So you could say what Wall Street says. If a stock is down 20% from its high, you're in a bear market. You could say what I say. If we're below the 200 exponential and simple and they both have a negative slope to the downside, just be able to clearly define it to where somebody that has no idea what's happening could easily just say, okay, so I don't know how to use TradingView, but you're going to show me and say, okay, if we pick this as the top right here and we take our measuring tool and we see, are we in a bear market? No, we're only down 9.8%. We're not in a bear market. Sure, that's fine. And that's okay. It's very clear, very definable, and takes 2 seconds to determine. Or you could say to somebody, hey, we look at this chart, and when the 200 exponential and simple are positively sloped, they're blue. When they're negatively sloped, they are red or pink. And that is how we determine a bull market or bear market. So anytime during here, bull market. Now, bear market. Sure, it's very easy to find, very clear. There's no question in your mind. You might have this little area right here where it could go either way. You kind of have some red, and then this one's still blue, and then you're under here, and now they're both red or red and pink, and then this one kind of flips blue, and you're like, well, maybe they save it. That's fine. There could be a little indecision as we're determining, as the market is deciding, are we in a bear market or bull market? That's okay. You can be neutral then, or you can be neutral with a bearish bias or neutral with a bullish bias, whatever you want to be, but be able to clearly define that, because we know that if we trade with the trend, if we invest with the trend, that we have a higher probability of success. So if I told you we're going to bet on a coin flip, 50-50 chance it goes heads or tails, there's no increased probability of success. It's just 50-50. But if I tell you, obviously this is not a real thing, but if I tell you that if it's between the hours of, noon and 12 at night, and we bet on a coin flip, there is a 10% higher probability, that heads comes up. So now you say, okay, 10% better chance, heads comes up. So depending on how you're calculating it, either it's 55-45 or 60-40, whatever you want to call it, but there's a higher probability of success of heads when the sun is out, when it's daytime, between 12 and 12. So you have a edge on the market, a higher probability of success. So that is how we look at a bull trend. When we're in a bull trend, if we take a bullish trade, we have a higher probability of success. Now, is it 1%? Is it 2%? Is it 10%? Is it 50%? We don't know. You don't know. But it's much higher when you're trading with the trend. So if we enter into a bear trend, we know now the probability of the market continuing to the downside, the probability of a successful bullish trade is now less than 50%. So we would rather either be neutral or we would rather be negative or bearish or shorting or, taking options plays to the downside on a longer time frame. Maybe we have a bullish move inside of that, the same way that we're in a bearish trend, but we have a bullish trend throughout here, but we have a bearish move, and then we have more bullish. So the idea behind that is, even if we have a pullback, we still continue going to higher and higher prices. So when we're in a bear market, even if we have a pushback to the upside, we still continue to go to lower and lower prices. Slinky theory, full effect. So that's what we're paying attention to. So for now, as long as we're in this bear trend, as long as we're in our definable bear trend or whatever your definable bear trend is, or whether you're neutral, whatever it is, as long as we're inside this white channel, as long as we're below the 200 exponential and simple, we're bearish on the market. So we don't want to be buying the dip the same way that we did on the way out. So now inside of this range, we're towards the bottom of the range. We bounce off the heart line. We're under the 200 exponential and simple. We're under the green support / resistance. So we know with a higher probability than 50%, maybe 51%, maybe 75%, we know that, a week from now or a month from now or a year from now, if we're still in this bear trend, that the price's probability is higher, that it will be lower than it is that it will be higher. So continuation to the downside is what we expect right now. So, we're basically one candle away from new lows. And we only have one candle now below price action. So people are like, this is the bottom. This is it. I'm buying the dip. Okay, great. Talk to me in a week. Tell me how that worked out. Talk to me in a month. Tell me how that worked out. Because probability tells us that we're going to continue to the downside. And if we turn off our drawing tools and we switch to a longer time frame, let's look at the weekly on the Dow Jones. Well, what happened on the Dow now that we've been talking about and anticipating? We got the 821 cross on the weekly now. We had an aggressive attempt to save the trend, a pretty aggressive candle, a single candle, being bought up, a hammer telling us, no, we will not go lower. Prices will not go lower. And everybody ran in and bought up the market. And then since then, we've only gone lower. And now on the weekly, we are 3 hours and 55 minutes away from closing this weekly candle. And it's a very bearish looking weekly candle. And it's basically saying the market stepped in and bought everything up and said, that's the bottom. And I'm Cathie Wood, so that's it. I declare the bottom. And then the market says, okay, we don't care. And just continues to sell off and makes Cathie look stupid. So that's what's happening here. So one single candle says we're bullish. The trend now says we're bearish. So I trust the trend over a candle. Although the candle can be useful, a candle is the least reliable form of, technical analysis. A candlestick pattern is the next. And then after that, we have, some sort of like trend. We have indicator oscillators. We couple all these things on top of each other. And then we decide what the probability of these things playing out is. And that's why we look for confluence. So if you have a candle and inside that candle, it's forming a candlestick pattern. And then inside that candlestick pattern, we're seeing, indicator oscillators lining up as well. We're seeing moving averages. We're seeing whatever it is that we're looking at. The more of those things line up, the higher probability of success that candle is telling us that that was the bottom. But if we have a bunch of things telling us that we're going to go lower, say for instance, the 821 cross to the downside, say we have a bearish candle afterwards, say we have a hard sell signal and trending stochastics to the downside, say we have the TJD, TDMACD, trending to the downside, red slope line, below the zero line, bunch of red histograms, all those things. And then it's like, but we have a bullish candle. So do we trust that candle? Or do we trust all the other things that are telling us that candle's wrong? You can decide. It's always up to you. Obviously, the candle could be right. It's possible. But when we have a bunch of things pointing down and then one thing saying that was the bottom, I trust the things that are pointing down. Now, could this get bought up by the end of the day and then we close right here at that same support zone and then maybe we get continuation next week? Sure, anything's possible. But right now, what we're seeing is there's momentum to the downside. And then we've been through this a couple times before, but there's a lot of new people on the channel. Let's talk about this. We're in the macro on the weekly chart. We're in a bull trend. We've been above the 200 exponential and simple moving average since December of 2011. So since 2011, on a long enough time frame, if you bet against the Dow Jones, you lost. You're wrong. So it makes sense to be bullish on the Dow Jones always since 2011. For the last 11 years, if you were bearish on the Dow Jones on a long enough time frame, you were wrong. If you were bullish, you could be a moron, but you were right because you traded with the trend. So eventually we put in higher prices every single time. There's no time you could have bought from 2011 till now on the Dow Jones that now later on you would be negative, with the exception of this little bit right here where we, potentially topped out, or at least short-term did. So on a long enough time frame, buy the Dow Jones, it only goes up. Sure. But inside of that trend on the weekly, we see these pullbacks where the 8 and 21 cross the downside. And we know what happens when we see these happen. So we're going to go back and look at from 2007. So here the 821 cross the downside, we retest the 200 exponential and simple. Here we try to cross it back to the outside, it fails. We go into a bull market on the weekly. That's the least common scenario is that on the weekly, the bear market happens. The 200 exponential and simple turn red and pink respectively, and then we sell off. This was obviously a big deal. The GFC, global financial crisis, real estate, bubble burst, whatever you want to call it. This was a massive event. These are the least likely scenario to happen. These happen, every 10 years, if that, whatever. Since then, every other time we had the 821 cross back down to the downside, what happened? Even though we're in a bull trend, confirming from right here, 821 cross the downside, we retest 200 exponential and simple. 821 cross the downside, retest 200 exponential and simple. 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 This was COVID. Was this the 10-year event? Was this the 1 in 10 years roughly? Sure, maybe it was. But now we're seeing the 821 cross back to downside. So what does that tell us based on these previous events that we see here? 1 time, 2 times, that's kind of just already on top of it. 3 times, 4 times, 5 times, 6 times, 7 times. So the last 7 times we crossed 821 to the downside on the weekly. What happened? We touched a 200 exponential and simple. So this is the 8th time. So we can say with 100% certainty over the last 7 times the 8 and 21 crossed the downside on the weekly for the Dow Jones that we touch a 200 exponential and simple. Does it have to happen again? It does not have to happen again. But we know based on history, based on the last 7 times it's happened, that with 100% probability it happens. So again, does not have to happen this time, but we have a strong reason to believe based on technical analysis that it will. So what do I expect? I expect Dow Jones to retest the 200 exponential and simple now that this has happened. And where does that line up with roughly? We have a top right here from right before COVID, February 2020, resistance. And that just so happens to line up with roughly, if we extrapolate out into the future where the 200 exponential and simple would be, they will roughly just continue along that trajectory, roughly somewhere around that same level. So this retest 821 to the downside tells us we're probably going to hit the 200 exponential and simple. We have a very key resistance that we would expect to act as support right here at 29,500. So that tells me with pretty high certainty that that's probably where we're going. So if something doesn't change, if we don't reclaim the 821 back to the upside, cross them green and whatever, I'll change my mind if that happens. But in the meantime, there's a 100% certainty over the last 7 times this has happened that we at least come back down and retest those. Does not mean it has to happen with 100% certainty into the future, but there's a very, very high likelihood based on history that it does. So that's what I'm betting on. That's what I'm expecting. That's what I'm planning for. So from the top to that point, we hit 37,000 and we're going to go down to 29,000. So at that point in time, we're going to be down 20%. So then everybody will be like, oh, it's a bear market officially. So Wall Street's going to be saying it's a bear market when we're hitting the 200 exponential and simple on the weekly. So that's when they're going to say it's bearish. Dow Jones is officially in a bear market now. We have already declared that based on, our style of trading or technical analysis, whatever. That's fine. Doesn't matter who's right. Doesn't matter who's wrong. It just matters if you make money. So are we going to make money off of this move? Of course we are. We make money off of buying that move once we get down to it? Of course we are. But in the meantime, that's what I'm expecting. Until something can come and change my mind and tell me, hey, maybe that's not going to happen. Maybe we are going to bounce this area and move back to the upside. Maybe things are changing. Maybe whatever. But in the meantime, that's what I expect. So does that scenario that everything is pointing to tell me that we should be bullish on these markets, that we should be buying the dip, or tell me that there's much more potential downside? Of course, downside. If we switch to a longer time frame on the monthly now, and we look at this, we see once again, every time we leave the bullish control zone, get a hard sell signal, leave the bullish control zone, get a hard sell signal, leave the bullish control zone, get a hard sell signal, leave the bullish control zone. What happens? Well, every time we have a varying level of aggressive dump back to the downside. So again, the retest of 29K, roughly right here is going to put us at the top of that peak right there, roughly. And maybe that will be the bottom and that's it. Maybe we have a more aggressive sell-off like it did with that Rona dump and nearly touch the 200 exponential and simple. But again, on the monthly, we know in a long enough time frame, we should always be bullish on this. So we don't necessarily want to bet against it, but depending on what time frame we're looking at, we don't want to just suffer through a year or two or whatever of pain because we're just like, well, all you have to do is just buy the dip. Every time, it's fact. So that's how I look at it. Depending on what time frame you're looking at, you should always be bullish on the Dow Jones on a long enough time frame. But can you take 20% hit to the face? Are you getting ready to retire soon? Can you suffer that much of a drawdown without selling? Like, I don't know. It's up to everybody, So SPY, same thing. We're below the 200 exponential and simple. 200 simple is starting to roll over. It basically has a flat slope. We retested it. We got rejected. We're a couple candles away from the lows here. Starting to get bought up a little bit. We got like 4 hours to close this. We have a little bullish divergence. SPY looks slightly better. But overall, same exact thing. We look on a longer time frame and we see what happens here. SPY's got that 821 cross to the downside. So we know here, we retested 200, retested 200. Here we have front run slightly, but then we retested 200s. Here, 200s, bear market. So we see same exact thing showing up here. So with very high likelihood, with extremely high probability of success, we know that we could expect maybe we have an aggressive move back to the upside. Maybe this turns into a head and shoulders, and then we get the measure move breakdown, and we're at the neckline right now. So maybe we're already putting in the lows. Maybe we come all the way back up to 453. And then maybe we get rejected there, and then maybe we sell out. I don't know what's going to happen exactly, but I know with a high probability of success, we are now going to revisit the 200 exponential and simple. So do we get all the way down to the Rona peak at 337? I don't know. Maybe not. Maybe we overshoot the 200 exponential a little bit. Maybe we hit the 200 exponential and simple, and we front run this top a little bit, and we don't retest it. Either one of those is easily a possibility. But with very high certainty, with very high likelihood, we are probably going to be coming down to 300 and let's say 50 roughly. And that's what I expect. Momentum's in our favor. Everything is telling us that is most likely what's going to happen. IXIC, NASDAQ. So again, selling off, bear market, measure moves to the downside. We're headed down to like 12,000. We know with high probability of certainty, that we're at least going to come back down and retest the 382 after breaking through the 236. The next target for the fib would be 11,531. NASDAQ obviously looks like trash. The actual NASDAQ looks much better than like the components of the NASDAQ, with the exception of, the ones I can count on a single hand. Russell looks like straight up trash. I hear people saying small caps are the way to go. They're going to outperform based on the past and coming out of a recession and this, that, and the other. The small caps outperform the large caps, and it's all about this and that and the other. Do you think going into the future, small caps can outperform the large caps? Fuck no. Most of these companies are going to die. These are zombie companies making this up. It's the worst chart. It went sideways for the most bullish market ever, and it just went sideways for month after month after month. For a year, it went sideways and did nothing. Distribution took place, and now it's selling off, and now it's potentially coming up to retest the breakdown before it goes much, much lower, as most of these companies probably die. And they'll get replaced with new companies that are better, that actually make money. Definitely. But we're very, very much in a bear market. The Russell 2000 is trash, and soon it's going to be worth less than $2,000, so they have to switch the name to the Russell 1600. Not literally, obviously it's 2,000 stocks, but just joking about the price and the composition. Energy, XLE, surging to the upside, continuing to move to the upside, continuing to go parabolic. And we know, obviously, that energy going parabolic is usually like the final push, before we see, a bear market in the world, or, the economy, or whatever you want to call it. So, we can look back at this chart right here, and we can look at some key peaks that we see kind of popping up. So we know this was like 99, 2000 when the surge to the upside, put in new all-time highs, and then capitulated, went into a bear market. This was the 2000.com bubble burst. We know the next one, 2008, energy peaks, it spikes to the upside, and then capitulates, global financial crisis. We know 2014 crash, okay? We know this was obviously a lower high, but, 2018, massive sell-off in energy. And then we know we had like the little Rona dump right here before our big capitulation move. Basically, obviously oil going negative and all that stuff. And now here we are surging to the upside, going parabolic. So is energy going to top out right here? No, probably not. It's probably going to keep surging, at least for a little bit, until something changes. But we know when this peaks that what comes afterwards is pain. Lots and lots and lots of pain. So is it 3 months from now? Is it 6 months from now? Is it a year from now? Is it 2 years from now? We don't know that. But we know that when this peaks, massive amounts of pain on the world, on the economy, on, asset prices. We know that because we can see every time this spikes, it's pain, big time pain. So we'll see what happens. Obviously, it looks bullish right now. 200 exponential crossing back above on the weekly. XLE is looking pretty damn bullish right now. Getting ready to flip the slope back over on the 200 simple for the first time since, we haven't been in a bull market in energy since 2015. That's when we confirmed into the bear market. So we're getting ready to confirm into the bull market. So what does this tell me? Well, it's probably not going to end anytime soon. But energy was the trade. We've been talking about it for a while. Obviously, positioned in it. There's going to be fluxes to the upside and downside. Obviously, nuclear energy probably not the best place to be right now because everybody's afraid of the next Hiroshima or next nuclear power plant meltdown rather. Whatever their big scare tactic is. Because Russia's gonna blow up a nuclear power plant right next to their house. Sure, they're gonna set their neighbor's house on fire with nuclear energy. Sure, makes sense. Or maybe not. And market's just reacting because it's scared, because that's the scare tactics that happen with nuclear power. So you can push your green agenda with wind and sun and unicorn farts, instead of oil, which is the thing that actually works. And obviously nuclear. So XTN, transportation sector, is still looking pretty toppy here. Very much in a bear market, starting to roll over right here. What is this? Is this transportation getting killed by oil prices? Is it starting to get to the point where it's too expensive to transport things because energy is too expensive? Because people are pulling back and they have less disposable money because they're spending too much money on energy, or companies don't want to spend the money on moving goods that they can't sell, or, whatever. The shipping containers are costing too much, or they can't get the goods they want, or, airplane jet fuel is costing too much. People aren't flying to Europe anymore because they're afraid to go there because of WW3. Whatever the reason is, it doesn't matter. The fundamentals, the technicals are telling us we're in a bear market in transportation. And, we know obviously that this is typically when transportation tops out, like cyclically. We can see obviously these various red lines along the way here. We can see this is a very cyclical. Let me go to a longer time frame. Each of these cycles lines up, basically with like the end of the year. So we can see that these various, I think I might have accidentally clicked on this and moved it slightly. Actually, I think I may have moved these slightly off a little bit. Okay, that looks a little bit better. But anyway, we see typically, with these cycles that they happen around the same time, and we typically see like peaks around this certain time of the year. And it's typically towards like, November, December, January, something like that. Now, each one is obviously not a macro peak, but we know that when they top out, obviously the economy slows, etc. So we can look at various times in history, what happened during those times, what it looks like, and that's where we get like the transportation starts to slow, the economy starts to slow. As transportation prices go through the roof, the economy starts to slow because they can't afford to transport the goods, services, whatever. The input costs go up for companies, so they can't make as much money. GDP goes down, people stop flying, whatever the situation is. So that's what we're seeing here. We're operating inside this channel, very much in a bear market. If we break out to the upside, we have a measure move up. If we break out to the downside, we have a measure move down. Again, I still think that we're more likely than not going down. So XLF, financial, obviously, there's people saying buy the dip, rates are going to go up, banks are going to make money. You guys know how I feel about that. Banks don't make money on the rates, they make money on the spread. So if they're making their spread at 0% rates, if the rates go up, like the Fed funds rate goes up to 5%, let's say, which it's not going to do, but let's say it did, they're going to make a spread on that. So if right now the rates are at 0, and let's say for a mortgage, they're charging 4% for a mortgage. So they're making 4% more than they're paying to borrow that money. So then let's say that the Fed funds rate goes up to 2%, and now a mortgage is 6%. They are still charging 4% because they're making that spread. So they don't make more money when the Fed fund rate goes up. They actually make less money because if you look at it as a percentage of the investment, if they're paying at 2% and they're still making the 4% spread, sure, they're still making 4%. So it's the same, right? Well, no, it's not. Because before the risk was 0 because they were getting the money for free. Now the risk is 2. So not to mention that as those numbers go up, the spread might stay the same between those numbers, or maybe it even slightly increases, but the risk or the cost of them giving that loan or whatever goes up higher. Not to mention the cost, of default or the likelihood of default or whatever goes up as well. So brain dead people that don't know what they're talking about talk about how when rates go up, banks make more money. But we all know that it's the opposite. We all know that the way banks work now is off the spread, and that the majority of what they're doing with that money is they're taking the money and then they're investing it probably in the stock market or some other form of, wealth creation. So the rates are actually good to be low for them because that drives asset prices higher. So if asset prices come down, sure, they're still making a 4% spread, but now asset prices are coming down because the rates are going up. So now they're loaning you, instead of loaning you, $1 million on this house at 3%, now they're going to loan you, the house is priced way less because the rates have gone up, and obviously they act inverse. So now that same house is not worth $1 million anymore. Now it's only worth $750,000, but the rates now are 6% because, there's a 2% Fed funds rate. So now they give you a smaller loan. So they actually are making less money. The spread is still the same. They're making less percentage, even though the spread is still the same because the Fed funds rate is higher. And then they're giving you a smaller loan because the value of the house is lower. Plus all the other money that they've invested in all the other things, is worth less as well because the asset prices are coming down because the Fed funds rate is going up. So, it doesn't make any sense. It's the same thing it's the same argument from like boomers and people that don't understand how things work now. Things are different. It's not 1980. Okay. Sorry, but no. So in my opinion, financial sector doesn't look good. Doesn't look good. Where's the price action at right now? Well, it just wiped out back to May of 2021. So, it basically just wiped out the last year worth of positive price action to the upside. So anybody that bought into this in the last year is probably either neutral or underwater, essentially. So probably headed down to like $35 here to retest that key level. Doesn't look good. I don't like the financial sector. VWO, Vanguard, and not to mention, you got potential things that are upsetting it into the future. I'm not saying it's going to happen, but, Alipay or, PayPal or, crypto exchanges, whatever it is. There's lots of headwinds for the financial sector, including rates going up. That is not bullish for them, even though people would argue that it is. They're wrong with 100% certainty. VWO, Vanguard, FTSE, emerging market ETF, obviously looks terrible. So we basically just got a new gap down to a new low. So we've been talking about how terrible this is, how bad it is, how we're expecting a retest of the 200, or of the blue ascending support line. We got that initial push down, we got back up, retested as resistance, and then failed. And now here we are at a new low. So this further tells us, where do we want our money? Do we want it in the United States? Do we want it in Europe? Do we want it in emerging markets? No, we don't. You want to, invest somewhere that's strong. Invest in Brazil or something like that. It's not financial advice, but, Brazil has a ton of commodities and less headwinds. So they're probably going to appreciate compared to a lot of these other things. You want to invest in some of these places? Doesn't seem like a good idea to me. Do I want to buy the dip on Russia? Probably not. You think anybody's going to want to invest in Russia? You think anybody, even if everything just stopped tomorrow and went back to normal and Russia was like, hey, sorry about that. I was drunk on power, made some poor decisions, not going to happen again. Let's just go back to normal. Do you think the Russian economy just recovers? You think the Russian stock market just recovers? You think trust and faith in Russia recovers? Or are people just going to be like, yeah, how long till Putin just does that again? No, it's going to be terrible. It has lasting effects. They're going to be a pariah now for however long. And I'm not saying that they shouldn't be. I'm not saying that they should be. I'm just saying that's what's going to happen into the future. So DAX, Germany, we've been talking about how terrible everything is for Germany. This is the worst situation for Germany because they basically have to be the one who takes a stand. They have all Europe pointing at them going, hey, man, don't you dare certify that Nord Stream 2 pipeline. Don't you do it, Germany. Don't you do it. And they're the ones getting screwed by it. So they're having Europe saying, hey, don't do it. But also they're like, well, we're getting screwed. U.S. is saying, hey, don't you do it. We had a deal, remember? You can't certify Nord Stream 2 if Russia acts a fool. And now what's happening? Capitulation. This is the bloody waterfall we talk about. When we break down from this descending channel, when we break down from it, what happens? A big waterfall. It just goes straight down, just pours out, and it's red, the blood, the losses. Looks absolutely terrible. And, we're at a key support, but what has happened in the past? I mean, this is going back now, years and years and years. What has happened in the past? Well, we had this massive outlier to the downside. We don't have to have that. Maybe we just get one of these little pokey guys right here on a longer time frame and it rallies back up and everything goes back to normal. But we know that even on the daily, whenever this went into a bear market, it retests the bottom of the range. Bear market retests the bottom of the range. Bear market breaks way down from the range. Bear market retests the bottom of the range. Saw this coming a mile away. Germany is the worst place. Well, not the worst, but a bad place to have your money right now. I'm sorry, but it's true. Let's decommission our nuclear power plants and then rely on Russia for oil. Oh, Nord Stream 2 is built. Hey, everything's great. Oh, wait. Oh, that was a bad idea? We shouldn't have decommissioned our nuclear power plants until after Nord Stream 2 was good? And even then, we might be in trouble? Oh, okay. So I'm seeing a trend here with people getting ahead of this green energy thing. And not to mention, nuclear energy is the most green energy. Not the most, but one of the most. Oh, these people. CM50, China, still looks terrible. Finally broke down from support. Been hanging out at the same support. And we know the bouncy ball, it bounces on the desk, it bounces on the desk. Each time it bounces lower and lower and lower. And then eventually it rolls off the desk and it falls. So this one looks like it's getting ready to pull a Germany. Now we have a bunch of support through this range. Previous top highs right here. We have a bunch of chop around here. But it looks like China is going much lower. Much, much lower. Very clearly in a bear market. So where do we get bearish on China? Right back here. Where's China at now compared to that? Down like over 15%. So UK 100, everybody was trying to get bullish on UK. Everybody was talking about how UK is the place to be. It's great. Invest in the UK. Well, the chart looked better than a lot of places for a while, but we know that UK is having all kinds of issues with Brexit, with natural gas prices, with, energy in general. Their real estate market's like over the roof, like through the roof. This was a retest of 200. Should have got aggressively bought up. Well, it did. Got aggressively bought up once. And then what happened? It just sold back off, melted down. And now we're very clearly below the 200 exponential and simple. UK market, it looks terrible. It literally just wiped out gains all the way back to April of 2021. And we're very close to wiping out gains back to January of 2021. So the FTSE UK 100, does not look good. We've got some support back here at like 68.15. But it looks like Wreck City. This type of candle right here is the worst kind of candle you can get. Maybe this will be the bottom. Maybe come back up, retest 200 exponential and simple, reversion to the mean, see if it acts as resistance. Then we go into a confirmed bear market, whatever. Sure, but it looks terrible right now. Absolutely terrible. So where do you want your money? Do you want it in Europe? Do you want it in Canada? Do you want it in Germany? Or, all these different places have so many headwinds right now. You want to buy the dip on Russia? Or you want to be in emerging markets? No, people are running to the world reserve currency, quote unquote, right now for stability. And that is why the dollar is strong and will continue to be strong until some of these headwinds lift. Until people are not worried about energy. Until people are not worried about war. Until people are not worried about, Justin Trudeau, whatever. I'm going to take a quick drink and then we'll keep on ripping. If you got any comments, questions, anything like that, now's the time while we're taking a quick break. And by quick break, I mean like 30 seconds. Peter Gerd says, have you heard about the new Rolls-Royce mini nuke reactors? Yeah, I've heard about them. Haven't actually seen anything positive so far. As far as last time I checked the stock price, I think it was for you. Still looked atrocious. The plan is these can be assembled on a production line, quick to set up anywhere. Yeah, sure. There's definitely potential for that going into the future, but we'll see what happens, man. There's a lot of headwinds right now on nuclear power. We've been expecting a pullback on uranium. And, obviously, the reason that nuclear power had such a bad, stigma behind it for so long is because of, a couple of, big reactor issue leaks, whatever. And then, you hear about it on the news and it's like, oh, nuclear power, it's scary, it's terrible, and nobody wants it. Get away from nuclear. And it's just now starting to like kind of fade away. And now, obviously, this Russia situation, everybody's like, oh no, it's going to be another nuclear meltdown and radiation and, scaremonger tactics. But I do think going into the future, nuclear power is a good bet. But, we have been expecting a pullback on uranium. Matter of fact, that last push up was, I don't want to say surprising because obviously we're expecting energy to continue surging. But it was a little unexpected, a little more aggressive than I was expecting. But we'll get to that in a minute. Let's look at crypto. So Bitcoin futures chart, what's it look like now? So we sold down below 200 exponential and simple, confirmed bear market, got a reversion to the mean retest, played that to the upside, took profits along the way on the majority of our position, came back down, put in a higher low right here. Again, took a little scalp back to the upside. Again, took some profits along the way. Still have open a small portion of that position, but overall, I don't like to get greedy on this stuff. Very possible we come back down here, put in a higher low once again, come back up, retest it. The more times we retest it, it's going to look like an ascending triangle and possibly break through it and come up here and put in another lower high. Maybe it looks like a head and shoulders. Maybe it just looks like a double top and we break down. We don't know what's going to happen, obviously, depending. But overall, doesn't look particularly good. And we got an aggressive candle push up here, and then we're just selling back off. So I talk about this all the time. When we're on the way up, in a bull market, you take, the stairs up, the elevator down. So a bunch of small candles to the upside and then one big red one. Bunch of small candles to the upside and then one big red one. Bunch of small candles to the upside and then two big red ones. So that's the stairs up and then elevator down. So once you're in a bear market, it's the opposite. So, we're obviously arguably like considering bear market here, possibly double topping. So then we start just taking the stairs down and then we get one aggressive candle to the upside, the elevator back up, stairs back down and then elevator up, and then stairs back down and then elevator up, and then stairs back down and then elevator up. So if you're not already in the market, you have these two candles to the upside and then it just melts straight back down. If you're not already in the market, you have one candle to the upside and then it just melts back down. So that's what we're talking about, these aggressive rallies inside of bear markets. So, we're trying to flip this back over, but we're essentially just getting rejected at a lower high right here. So while we're trying to put in higher lows, this is basically just a small, potentially bullish trend inside of a bearish downtrend, inside of, a bullish uptrend that is starting to flip bearish. So doesn't look particularly good. We had some bullish divergence. It played out. We got the reversion to the mean play, but it looks like at this point in time, we're having trouble reclaiming the 200 exponential. So when we come back down here again, the most important thing to pay attention to is, do we put in a higher low than 37,500? So, but realistically, we don't need to pay attention to the futures. We need to look at the spot chart because we're going into the weekend. We know futures is going to be closed. So we know that the crypto call is going to have an opportunity to push up the price here. So while the adults are spending time with their families and, taking the weekend off, we know that the culties will be over here trying to pump up crypto, talking about any bullish news possible. Oh, Russia's skirting sanctions with cryptocurrency. Bullish. Canada is skirting, the government with cryptocurrency. Bullish. Well, are you sure? Because probably going to be some headwinds from regulation. Because if there's one thing governments don't like, it's when people do shit that they told them not to. So they either put you in jail, take all your money, or shoot you. So none of those sound good. So does crypto get put in jail? Does it get all its money taken away, or does it get shot? And people are like, they can't hurt crypto because it's decentralized on the blockchain. What don't you understand, crypto transgender? You're dumb. Or they don't have to shut down Bitcoin. They can just stop you from using on and off ramps. So you're like, oh, I'm rich. And they're like, sure, really? Are you rich? How are you going to be able to spend any of that money? Or our bank's not going to let you take it out? Or our bank's going to report to the IRS, when you transact in cryptocurrency? Or are you going to have to prove where you got that money when you put it into the bank to get it? So you could be a trillionaire on paper, but if you can't take your money off of the internet and then take it and buy actual things or spend it, what use is it? And you're like, yeah, but you can barter with it. Sure, you could trade it with someone else. And then if you get caught bartering, I don't know about every country, but if you get caught bartering in the United States without declaring it, you go to prison because that's federal crime. So better pay your taxes. Better be careful skirting sanctions. If there's one thing you shouldn't do, it's be a criminal. So even if you're willing to be a criminal, even if you don't care what the government says because you don't agree with them and you're a rebel, the majority of people have families or property or don't want to be like convicted felons and go to prison. So most people are probably just going to do what the government says. So even if you're some rebel and you're like, I'm skirting sanctions, I'm not paying taxes on my crypto because I'm a rebel and I don't care and I'm a freedom person and you just are stuck in the system and you just do whatever the government tells you like a good sheep. Okay, sure. That's I totally agree. I follow the laws. Most people follow the laws. So if there's a law against something, a lot of people are less likely to do it. That's the purpose of the law. So if the governments decide they don't want people skirting sanctions or skirting, the Canadian dictator or whatever it is that you're doing with crypto that they don't like, not paying your taxes, whatever it is, if they decide they don't like it and decide to make you a criminal or you're already a criminal for doing these things, be careful because it's not going to look good on the price, in my opinion. But what do I know? Maybe the governments will get toppled and we'll all just be free. So Bitcoin looks terrible. Bear market, below 200 exponential and simple. Retest, sort of looking like a double top. Arguably had some kind of like double bottom. Maybe this turns into a, ascending triangle and we have a hard resistance flat up here and a ascending resistance right here. And then it breaks to the upside and then we come back up. Maybe we put in a new all-time high. We see it coming from a mile away. Doesn't look like it for right now though. And this is my point here. We have one big candle up, a little bit of an up, and then meltdown. One big candle up, meltdown. This looks like distribution to me. If you had a ton of money and you were trying to get rid of this or a ton of this asset or whatever, and you were trying to get rid of it and the price kept going down and you're like, okay, I'm just going to push it up. I'm going to get all the dumb people to buy in to the momentum and then I'm going to dump on their faces. And then I'm going to get them to buy into the momentum again and then I'm going to dump on their faces. And then I'll get them to buy in the momentum again and then I'm going to dump on their faces. And then eventually, once the distribution takes place, once the last point of supply takes place, then we break back down to lower prices and then we do the same thing all over again. So does it have to happen? No, maybe we get bullish from here, but right now we're below 200 exponential, we're below this 200 simple, and this is a bearish trend. This is a bear trend. So again, as long as we are getting, and this is exactly what we spoke about happening, was the rejection of the weekly. We talked about the two best case and worst case scenarios. We said best case scenario, we push all the way back up above the 21, and then we close above the 21, and then we likely see continuation on the weekly. That was our bullish trend. The bearish trend was, or the bearish, result for this weekly was we push up to the 21, we get rejected off the 21, close back down below the 8, and then it still looks bearish. Bears are very clearly in control. We see we're in the bearish control zone. We call it that because it means the bears are in control. So more likely than not, a rejection off our moving averages, a close below those moving averages, and continuing inside the bearish control zone, we most likely go lower. Now, maybe we get a pop over the weekend. Maybe something happens. Maybe something changes. Sure, anything can happen. But right now, this still looks very, very bearish. Still looks very bearish. We need to reclaim those levels. Now, obviously, this will be open over the weekend. But if we look back at the futures chart, we know obviously that will be closed. And they're more likely than not going to come back into a line. So we know that we have basically 4 hours and 30 minutes to at least close back above 41,370. The best case scenario is closing back above 44,920. Call it 45,000. Doesn't look likely right now. This looks like a very clear rejection, and we'd never like to see the wick, 50% of the candle, because that is like more of an aggressive rejection. So again, doesn't look good to me. I mean, it could be worse. Obviously, we could be much lower, but not what I like to see. Ethereum rolling back over. We still have a higher low for now, but this is less bullish than Bitcoin. We're even closer to taking out this low right here. So a breakdown below 25.77 is going to look real bad on a daily chart. Still have some momentum to the upside. Still have some arguably bullish things, but the 821 has crossed back down on the daily. It doesn't look good. A close today on the daily below 2,800 is going to look bearish to me, and I do expect continuation. There's a hard rejection off the 200 exponential and simple. So we are bull trend, getting further and further away from 200 exponential and simple. Reversion of the mean retest. They don't hold. We break down. Reversion of the mean retest. We can't reclaim it. We break down. Reversion of the mean retest. We can't reclaim it. We break down. Lower high now. So now if we continue to sell off, we take out this low at 25.71. We're going to retest the low right here at 24.17. And if we take out that low, it's just going to be a high, a low, lower high, lower low, lower high, lower low, lower high, and then eventually lower low and then probably another lower high. Then that's what a bear market looks like. That's what a bear trend looks like. So Bitcoin dominance. Okay, so this thing is getting ready to close. 2 days, 7 hours left, and it's getting ready to close its first weekly above the 821 and confirm the cross. So we've been basically getting 821 cross back bearish in February of 2021, and we went into a parabolic uptrend, and now we're closing the gap on the 821 off of triple bullish divergence, and more likely than not, we're about to close that cross back to the upside. So if we know when we close to the downside, that was a bullish trend in crypto, we know that we close this back to the upside, it's probably going to be a bearish trend in crypto. As Bitcoin continues to gain market crap, it gains market cap against all of the shit coins. So we know now we have, 16,000 cryptos that do nothing, and then we have 10 cryptos that actually have a purpose or are useful or are not a scam. So the likelihood is that 15,990 of those cryptos lose a ton of value, and then the 10 that are less scammy or not a scam or less Ponzi schemey or not a Ponzi scheme probably gain some of that market cap, as they're not just some complete trash. Like, for instance, is SafeMoon going to be good? Probably not. Is Shiba Inu going to be good? Probably not. Is Cumrocket going to be good? Probably not. Is XRP going to be good? Probably not. Is Bitcoin going to hold its value better than all the Cumrockets and the SafeMoons and the Dogecoins out there? Probably is. So that's why the money starts to, people go further and further out the risk curve in a bull market. And then as the bull market contracts, as we go into a bear market, they say, okay, maybe I don't want something called Cumrocket. Like, it was fun. Maybe I don't want a cryptocurrency named after a dog that has the largest circulating supply and does nothing. So maybe I'll just put that back in Bitcoin, or maybe I'll put it in a stable coin or whatever in the meantime, and then we'll just see what happens there. That's what's happening right now. People are moving further and further back away from the risk curve. They're coming back to the more stable things, the Ethereums. They're starting to say, hey, maybe the Solana thing is not going to be the Ethereum killer. Hey, maybe Cardano is run by a trash bag, loser, nerd, piece of shit. Maybe XRP didn't put in a new cycle high, so it's actually garbage, and it's not going to go to $10 or whatever the cult is saying. Maybe, Cumrocket is a silly name, and it's kind of funny, and, it was fun to be like, I made my millions on Cumrocket. And they're like, really, what's that? And you're like, let me show you. I mean, come on. Let's be real here, guys. This is ridiculous. So, looks like we're going to come back up here, retest the top of the range, eventually get the measure move break of the top of the range, probably eventually retest 200 exponential and simple. We already see the 200 exponential and simple are flattening out the same way that we see in a bull market. When the 200 exponential crosses above the 200 simple, we're accelerating to the upside. We see the same thing in a bear market. So if the 200 exponential crosses back down below the 200 simple, it means we're probably accelerating back to the downside. If the 200 exponential and simple start to level out right here, and then the 200 exponential bounces to 200 simple, it probably means we have broken back above it. We're starting to flatten out this trend, and then we're probably going to go back to the upside. So I expect Bitcoin to gain market cap in comparison to shitcoins based on all of these different things. Hard buy signal, momentum in our favor, a bunch of green histograms, blue slope line, 821 crossing to the upside, 200 exponential and simple leveling out. Looks to me like that's going to happen. We'll obviously have to wait and see. Total market cap did the exact same thing. It looks exactly like the Bitcoin chart. You could literally put these two next to each other and take away the price. You wouldn't know what you're looking at because they look the same. Come back up, reject it off 21, closing back down below it. Obviously, this will go throughout the weekend, but we don't like this. We're basically retesting the low. So this candle right here is the only thing saving us from putting in a new low. So if we close back down below here, or we see any kind of bearishness, we're just continuing a downtrend. And eventually we know that the whole crypto cap goes to $1 trillion. Retest the 200 exponential. More likely than not. So that's what we're expecting. So obviously all these cryptos not looking good. It's tough to take counter trend trades on these stuff, but that's why I want to keep the stops tight. And if something doesn't work out, that's it. So it looked like we're gonna cross this back to the upside on Solana. It failed. Done. So cut it, run, gone. Maybe it still works out. We'll look at that. We'll reevaluate from there. But as far as I'm concerned, we are going back down here to retest the lows at 73. Solana looks pretty bad. AVAX, Avalanche, holding up for now. It came back down to the entry we were talking about. We wanted to see a slight pullback, but I don't think it's particularly bullish. I don't think anything is right now. So we'll see what happens. Maybe this thing runs over the weekend. Maybe this plays out. Maybe the avalanche trade was a good one. But in the meantime, 6% stop loss, 28% upside. We'll see how it works. It's definitely still possible, but the overall crypto market does not look good. So Avalanche looks okay, still potentially good. I did take a small position on Avalanche, full disclosure. Remember, this is not financial advice, not your financial advisor. Markets are extremely volatile. Please do your own research. Trade responsibly. Matic is next. Matic is at the top of the range. It's at resistance. It's at 200 exponential on simple. In my opinion, this either breaks out and goes to the upside, which seems unlikely, or it breaks down and goes to the downside. Probably puts in a new low. So Matic at like $1.15 or something like that seems more likely than a breakout and Matic at $2. But either one is possible. KDA, if you want me to keep looking at this, please let me know. Also, I don't mind looking at it, but I tend to cycle things out after you ask about them a few times, and I do it if you don't mention it again. So KDA, Kadena, just continuing to trade right at the 200 exponential and simple, just tightening inside this range right here. Eventually, it's going to have an aggressive move in one direction or the other. So if we lose the ascending support line right here, it probably continues inside the channel. If we break out of the channel, probably get the measure move to the upside. More likely than not, we see some clear resistance at $10. More likely than not, in my opinion, we move back down to like $6 if it's bearish. If we break down from this, we'll just continue to operate inside the channel. So we know the heart line, depending on when we get to it, is somewhere around $5. We know the bottom of the range is somewhere around 320. And we know that we've been just operating inside this channel with pretty much certainty. I mean, the top resistance is much stronger. The bottom support is a little bit less reliable because we've only got a couple touches, but we could probably do something like this and say, okay, it's sort of a descending channel. It's sort of an ascending, broadening wedge, descending, broadening wedge. There's a couple ways you can kind of look at it. Over time, it will obviously probably develop a little bit more. I think something like that is probably the best way to look at it for now. So that's what I would be paying attention to. But more importantly than that, way before we ever get back down to the yellow here, we'll get back down to the bottom of the channel. So if we get back down to the bottom of the channel, we'll start looking for the yellow because that will psych people out. If it looks like it's going to break down from the channel and everybody goes, oh, it's bearish, sell, 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 and then all of a sudden it bounces this descending support line right here, then that could be a great buying opportunity, at least for a quick scalp back up. But overall, looks neutral right now. Better than most cryptos though, because it's not horribly, terribly below 200 exponential and simple. DraftKings, I think we said we're going to stop looking at this, but it looks like trash. Failed breakout. Tried to move up from here, trying to push to the upside, and now it has failed. It's back down below support / resistance. It is back inside of the yellow trend line right here. So I would suspect that it just puts in new lows. Looks like trick trash. All right, let's keep moving. We got some commodities. So gold continuing to surge to the upside. We saw a pretty heavy rejection, and then we saw some continuation. Is it going to come back up here and then get rejected again? I don't know. Right now, to me, gold looks strong. I've been saying for a while, I was skeptical about this move in gold. I didn't know how it was going to play out, but we're seeing commodities surge. And the way I look at gold is, if you're bullish on corn or you're bullish on rice or you're bullish on oil, you can't just buy corn, rice, and oil and store them in your backyard. I mean, you can, but if the birds eat all your corn or it gets moldy or it rots or whatever, you're screwed. So you got to figure out some way to spend, 2 tons of corn. Inside joke. If you got gold bars, we know that historically your gold is going to be able to buy traditionally the same amount of other commodities. So if you need corn, you don't have to just buy all your corn now. You can buy some gold and you trade the gold in the future for the corn, and they're probably going to get about the same amount of corn compared to your gold, regardless of what the dollar does, regardless of what your currency does. So that's why people say gold is a store of value. So, silver is a little bit more of an industrial metal, but essentially the same thing. Now, I am very skeptical of these two tops right here and potential breakdown, but also I don't have to be super aggressive on gold for 2 reasons. One, I already have a position in gold because gold to me is like my insurance, my savings account. And then 2, we're only a couple % away from all-time highs. So if we're skeptical right here, what do we need? If gold goes up another 6%, we could say, okay, gold broke out to a new all-time high, so it's probably going to run. I would rather just pay that 6%. For me, that's 6% gold tax. I'll pay it. I pay 6% to find out if we're going to put in a new all-time high. If we put in a new all-time high, I'm extremely bullish on gold, and it just runs probably a lot. Maybe it goes to 10,000. Maybe it goes to 2,500. Maybe it goes to, 2,100 and it's a blow off top and then sells back off. We don't know, but I would rather pay the 6% tax to make sure that this isn't just going to be a little triple top BS. But that's just me. I'm also already positioning it. If I didn't have any gold right now, would I buy a little gold? Yeah, maybe I would, but I wouldn't buy it like, oh, I'm going to take this to the pawn shop if it goes down or if it goes up. I would be buying it like as a store of wealth, a savings account, schmuck insurance going into the future. Silver looking much less bullish. So we're not nearly as close to the top of the range. We are at the heart line. We know if we break through this heart line, we basically have like a double bottom pattern right here with the heart line as the neckline. And if we break through that, the measure move is essentially just back to the top of the range, essentially back to $30. $30 is obviously a problem area for silver. If we break through 30 with conviction, this thing probably goes to 50. Retest the previous all-time highs. Finally. And all the primates or silverbacks will be happy and everybody's joyous and whatever. I can't even think of the site. What's it called? Wall Street Silver. All those guys are going to be going nuts and they're like, we told you so. So everybody else doubled and tripled and quadrupled and 10x their money. These guys are just waiting to break even because they bought the top. But that's okay. I'm happy for them. I want them to go 50. Gold silver ratio. It's definitely looking at this point in time like it could potentially get rejected here and go back down lower. So we know that as long as this is getting rejected and going lower, silver is gaining value in comparison to gold. We know if this consolidates here long enough and breaks through, gold is continuing to gain value compared to silver. So the same way the Bitcoin dominance chart has me bearish on Bitcoin, even though Bitcoin was looking okay lately, this has me bearish on silver or gold breaking out to the upside. Because more likely than not, if we break out to the upside and gold puts in a new high, it's probably going to surge faster than silver initially, and then silver will pass gold percentage gains wise. So if this breaks down from here, it means silver is gaining value compared to gold. So that would kind of tell me that we're getting a breakout to the upside. But if this breaks up from here, it's telling me that maybe gold has the initial move and then it breaks down. But overall, I don't love this chart right now because the longer we spend at the 200 exponential on simple like this, the more likely we are to go up from here. If this gets rejected and we start to sell off, I would be much more bullish on silver. I will actually change my tune on silver completely. But again, I'm already positioned in silver. If I didn't have any silver or gold, I wouldn't mind buying the highs. I wouldn't mind buying, and just storing some away. But I wouldn't be buying it thinking, okay, if this goes up 20%, I'm going to go to the pawn shop and sell it. Because the premiums right now are just ridiculous on this stuff. If you're buying Silver Eagles at a $9, $10, $11 premium, that means in order to break even, silver's got to go to like $32, which is higher than it's been in, decades. I don't like that. COPX, so obviously got that aggressive move back to the upside. I do still expect a retest of the top of the range. If we get this breakout to the upside, the measure move, that's going to take us to new highs. Copper looking good. Another commodity. You don't want to just buy a bunch of copper and store it. So you buy gold and then you turn that gold into copper if you need to. Not literally, but, exchange-wise. Silver juniors breaking back above 200 exponential and simple. Starting to look good here for the first time in a long time. Potential for some upside breakouts. Potential. Gold starting to look very good. GDXJ obviously broke above our descending channel, above the 200 exponential and simple, and potentially starting to put in our measure move. I do expect there's a decent amount of resistance along the way up here, but I do expect 48.33. After that, next target 55.39, and then the measure move takes us up to 58.80. So gold, silver miners starting to look good. Keep in mind these are still way down over the last year or so. So the majority of the people that have been buying this on the way down are still very, very upside down. So the likelihood is that there's going to be a ton of chopping around on the way back up as people continue to just offload their positions as they realize they were completely wrong about gold miners. So this looks much worse than the actual gold chart. Now, if gold breaks out to new all-time highs, the miners probably go crazy. So that's when I would be real aggressive on the miners. But again, you guys know I'm building positions on gold miners, silver miners, and of course, physical gold and silver. And then obviously, we have primarily energy positions and, including uranium. and then also, you know, starting to build those pot stock positions, but expecting lower lows still on pot stocks. So CCJ, uranium, Cameco Corp, you know, basically our proxy for like the uranium market. So we saw a pretty aggressive sell-off right here as everybody was worried about, you know, nuclear fallout from Russia and the power plants. You guys know how I feel about that. I already talked about it. You know, we reclaimed the 200 exponential and simple, so that does look good. But we're still just putting in, you know, what amounts to, technically we took out this high right here, so maybe we're not just putting in lower highs. But again, we have a high, we have a low, then we have a lower high, so maybe we just put in a lower low. Got to wait and see. Starting to look a little bit better here. Starting to pick up a little bit of momentum. I'm still very, very bullish on uranium going into the future, but we could see some definite headwinds with the uncertainty, you know, with the news, with the fear mongering, etc. So long term though, again, same thing. If I didn't have a position in uranium or uranium stocks, or if I didn't have some yellow cake stashed under my bed, you know, I might start building a position regardless of drawdown, but I would do it slowly and steadily and carefully. You know, and that, again, we're talking about like a 10, 20-year position. We're not talking about like, okay, I'm going to take my uranium rocks down to the pawn shop and, you know, see how much I can get for them. Obviously, that's not realistic, but you know what I mean. THCX, again, just, I mean, new lows on this. This is our pot stock proxy. I expect these to continue putting in new lows. I mean, if we break down below like $6, it's going to look terrible. So still slowly, very slowly, just building a position on these, but building a position fully expecting it to keep having drawdown for months, maybe for another 6 months. I think as we approach midterms, though, I think pot stocks are going to see an aggressive rally. Now, does that mean they're going to break back to the upside and go in a bull market? No, but if they go from $6 to $12 and retest 200 exponential and simple, that's a 100% move to the upside. So I like my odds on that. I don't like to just pick bottoms on stuff like that, but I do like the way these look, especially because this is like the worst performing asset since like 2018 is pot stocks. So normally I don't like to buy the losers, but you know, I am actually bullish on the space overall. But again, you bet on the worst horse, expect it to keep losing. There's a reason it's the worst horse. So obviously carbon did not bounce to 200 exponential at all. I didn't take that trade, but you know, you could have took it confidently and just got stopped out. And it's like, hey, you can't win them all. It happens. Obviously, at this point in time, sold off aggressively below the 200 exponential and simple. Doesn't mean we don't reclaim it and continue back to the upside. Definitely some potential. But, you know, once we invalidate our target, once we see a breakdown past the level we're comfortable with, you know, we can reevaluate, potentially enter back in. But we see now, you know, basically a rejection of the stochastic right here. We're starting to angle back to the upside, got rejected, rolling over. Bears are fully in control. So we're now in the bearish control zone. We see that it's green for the first time since way, way, way back here in July of 2021. So we're seeing something change. We broke down from a key channel. You know, we lost a key level. We're breaking down below 200 exponential and simple. So not good. We broke down from the 236 and the 200 exponential and simple moving average. So at this point in time, next target will be the 382. We can reevaluate at $37. Try to take another scalp position back to the upside if we want for the reversion of the mean back to 42. Or we can just wait, see how it plays out. Obviously, you know, sold off pretty aggressively. But to no surprise, I mean, this played out exactly as we were talking about. We had, you know, bearish divergence developing. We got rejected at, you know, basically the heart line of the channel. So I think that was all I had for today. We did it. We made it to the end. Yay. I don't know if there's anybody in chat that wants a particular asset looked at that I did not already look at. Oh, you know what I did say I would do? Was the... What was it? Oh, the 2 10-year chart. I said I would show you guys how I do that 2 10-year chart. And there's a million ways that you could do your own. You don't have to do it the same way that I do. But if you wanted to pull out the yield curve inversion, you can obviously go to Fred data and do it that way. Or you can do it the way I do it. You can do whatever you want, obviously, because you're grown. Okay. All right, so I just go over to TradingView and I will put in US0 to Y the United States 2-year Treasury. And then we see when we put in US 0, it will pop up all these different time frames. So you can look at whatever ones you want to look at. But this is the 2-year government bond yield. So we pull that up here. And now I'm going to go ahead and just get rid of the indicators for now. So I'm going to leave on the TJD master. So we'll leave that on. And then I like to switch it over from candles. And then you don't have to. You can do whatever you want. You can switch it to line if you want. Or I like to use area. So I switch it to area. And it basically just highlights all the area underneath it with whatever color we're using. So in this case, blue. And then I will take the compare function. So depending on what version of TradingView or how you have this configured, it will either just be this plus with the circle around it, or it will be the plus with the circle around it, and then it will say compare right afterwards. You just click on compare, and then you can go through here and pick and have it compare to something else. So now we're going to take the US, oh, whoops, sorry. We're going to type in US again. I'm going to pick US10Y. That is the 10-year. So obviously it's US, and then the time denomination, and then Y is for the yield. So US2 is US02Y. US10 is US10Y. So we're going to pick that next. And now it's going to put it in line format. So now we have the 2-year in blue here. We need to put it on log scale instead of percent. And then we need to, so I have it on log auto right now down here in the bottom right hand corner. And then we're going to double click on this. And then we're going to switch from visibility, or no, sorry. We're going to switch from style where it says line. And then again, we're going to pick area. And then we're going to switch that to whatever color we want it to be. So in this case, I like it in orange. And then I want the area highlighted as well to be in orange. So we'll just go to the fill right here. And then we'll pick orange. You can obviously do whatever you want. It doesn't have to be the same as mine. You can pick whatever color you like, whatever. I just like the way it contrasts. You can pick your favorite football team or whatever, color of your sports team. Doesn't matter. And then the next thing I will do. So now what we have here basically is we have the gap between the 2 and the 10-year. So when the gap is big, there's a huge spread between them. As the gap tightens, we approach recession. Once the cross happens, the 2 and the 10 cross, that's typically like, means we're about to go into recession. And then again, they will sell back off. And then again, same thing again. So we see here now, the 2 is accelerating extremely fast towards the 10. The 10 is like kind of lazily, just like drifting up here, doing its thing. The 2 is going parabolic. And the problem is, the reason that this is most likely going to cross here soon is we see the 2 is going up very fast. And then when it sells off, the 2 is going down by about the same amount or less than the 10. So here we see the 10 was at 1.96 and then it went down to 1.74. The 2 was at 1.56 and it went down to 1.48. So we see now that the spread from 1.48 to 1.74. So if we take 1.48 and subtract it from 1.74, we see the spread is tiny. I mean, it's like what, 0.26? It's 0.26. It was 0.4 the other day. So we closed 33% of the gap in like a day. So anybody that says we don't see any signs of recession, the yield curve is not going to invert, we're not worried about the yield curve inversion, we're not worried about this, that, and the other. They're a retard. They're either blind, retarded, or both, or they're a liar. Because we know every time. Now you can do this any way you want. You can look at this any way you want. Okay, the way I like it and the reason I like to use the TJD master on here is technically what we're looking for is when the blue crosses above the orange. But you can also use the 821 cross because it signals the same thing on like the longer time frames. But the actual inversion is when the blue crosses above, blue crosses above the orange is the actual yield curve inversion. So here we see the actual yield curve inversion took place. That was in 2000. We see here the yield curve actually like inverted right here. That was in like 2006. And then, you know, kind of see like the same thing here again in like 2007, etc. But each time we see that happen, sometimes it chops around at that range, but we eventually end up going into a recession. So if we just use our drawing tool now and we basically just put, you know, I mean, it's obvious. You can look at this and be like, are we in an uptrend or a downtrend? Like, it's pretty freaking obvious. You know, we basically have a pretty clear resistance line right here that shows us every time the yield curve inverts, it does it at a lower level. So we're probably not going to get back to the same level as last time. We're probably going to invert somewhere around here. So now you can do that with, you know, that kind of shows like the actual inversion level where we would expect it to happen. You could, you know, do it on the 2, you could do it on the 10, you could do it on both at the same time, see how it looked. You do whatever you want, really. Let's do, what else did I want to do? Oh, I know what I want to do. Can't remember what it was. I think it was. Give me 1 second. I don't remember. Yeah, that one will work. All right, so this is if you just go under indicators and type in recessions, this one will pop up. It's called the US Recession Watch or US Recession Indicator. So all it does is highlights the background from when we had these recessions. Now, obviously, this only goes back to uh, 88, this chart does, but we know each time what has happened with these various recessions. So, and I can't vouch for how accurate these are. So really you could compare it to like the Fred data or whatever, but I think this one is, yeah, see, this one's not accurate. I don't think. Because this isn't correct. Yeah, I don't know. I'll have to mess around with it. I can't remember which one I used to put it in there, but I basically just drew in the lines myself for when the actual recessions took place. But that is how I did it. I will figure out which one that was. One of them posted up like at least the first like 4 correctly, and then you had to fix the one in 2019 because that one didn't show up on here. But essentially, all we're looking at is that, you know, we basically went into a recession. Hang on, I can just do it off my other chart. What, July 1990? Can just manually do it. It's not going to be quite as accurate, but yeah, July 1990. So we just put one in right there. And then we had another one in April. Is that giving me the right date? Hang on 1 sec. Yeah, April 2001. Had one right there. And then the next one was in December 2007. And then we have one for the Rona, which was pretty quick in February. Technically, 2019. So again, there's different ways that they calculate the recession or whatever, but we see whenever we have the aggressive crosses to the downside and we see it turns red and breaks down from there, we see that was basically in line with like the actual recession indicator playing out. So if we know that we're about to come up here and close this gap, maybe it chops around for a little bit. We come up here, we tag this line, maybe it hangs out, but we know more likely than not we have a impending recession coming. And we can tell just by the gap between these two that even if we do chop around for a little bit, like a situation like this, where it takes another few months before it happens, we know that, more likely than not, the economy is going to slow and then eventually we see the recession. And obviously this lines up with, 2000 market top, 2001 recession, 2008 dot-com bubble burst or the global financial crisis, etc. We had like a 2007 recession. So we had already went into the recession. It took a while for the global financial crisis or the housing market to burst. And again, we see the same thing here at like the February 2019 or whatever. And then obviously we go into like the Rona situation and it's like, oh, wait, so the markets already weren't healthy? Oh, when Jay Powell was raising rates and then had to aggressively pull back because the yield curve inverted, that they were already, going down, getting ready to get crushed? That's weird. Nobody talks about that. It was a black swan event, right? So look, it looks like we're about to basically get up here and go into one in the near future. Now, obviously, the yield curve would invert and then kind of roll over. We would expect it to happen somewhere around like the 2.4 area. But I mean, if we're at 1.5 right now and we're expecting it at, let's say, 2.5, what is that? That's 1%. So Powell's going to raise, 25 basis points here in March in like 10 days. And then they're going to raise 25 basis points at the next meeting and 25 basis points at the next meeting and the next meeting, and so what? We're going to get 4 25 basis point hikes. We're going to be at 1%. The yield curve is going to have inverted already way before that happens probably. And then we're going to go into recession, middle of the year, this year? Probably. I mean, probably. So again, this is not clockwork. It's not going to happen exactly right, but we can see the causation versus correlation, etc., and what happens when the yield curve inverts. And again, we can look at like the Fred data. This is just a little bit more like, visually appealing. So yeah, that is that one. Don't need you anymore. Peter said tumbleweed. Yeah, right? More like capitulation weed. Am I right? Uh, UniQ says request for HNT. Yeah, we can look at that. I don't know what you want it compared to. I'll just do USD, I guess. I don't know what exchange has a lot of history either. Maybe Binance to Tether. Doesn't look bad. Yeah, it's got a little history on it. I mean, not a ton, but I don't really even know what this is, so. HNT, I mean, it looks the same as everything. It's basically just breaking down below the 200 exponential and simple, starting to roll over. Slope is flattening out. Does not look particularly good. Doesn't look as bad as some other cryptos, but definitely looks like it is respecting a downward channel or some sort of descending pattern situation. I mean, depending how you want to draw this, looks something like this. Basically, I have two touches on top, lower high, and then we have two touches on bottom, lower lows. Clearly in a downtrend, very close to confirming a bear market. Getting rejected at key levels, including the heart line. We have obviously a previous high right here. Looks like it's headed down lower, probably to the bottom of the range. We have a pretty clear ascending, or I'm sorry, horizontal support line around like 1675. Looks like it's probably headed there. If we just drop a fib on it, probably going to see some kind of confluence with some fib levels here. So we are basically, so we have a pretty clear support where we're at, you know, at the 236 at about 20 bucks. And then if we break down from that, you know, there's a little bit of support right here around that like $16.50, $17 range. More likely than not, though, it's probably headed to the 382. Very clear support on the way up right here, over and over again at that 382. So that's probably where I would be looking at, like $10.70 if we continue to see downside pressure, which we probably will. Let's be real. Crypto does not look particularly great right now. You know, it had a little saving grace with the, oh, Russia's going to use it for remittance. Oh, Canada's going to use it to skirt the government. But I think some of that's starting to fade. You know, I'm sure that Michael Saylor got in there and bought up a couple $1 million worth of Bitcoin, started running his ad campaign. You know, I saw him on Valuetainment. But the only problem with people like Michael Saylor is he's a nerd. So he's smart. He's also good at marketing or sales. And obviously he's a scammer, so you got to be good to be a scammer. You can't be like, you know, dumb. You have to convince people to buy your scam. So when you put a guy like that, who's smarter than most people, in a room, and he starts talking about stuff that they don't know that much about in a, you know, overall positive setting, and, you know, he's good about talking, and he basically just regurgitates his same, like, speech over and over again. I mean, if you don't listen to Michael Saylor and think, man, he really just says the same thing over and over again, man, when you ask him a question, he just, like, sounds like he's reading from a script. Same way Cathie Wood is. Cathie Wood, when she speaks, she sounds like she's reading from a script. Well, innovation and genomics and the exponential yield curve and yield curves feeding yield curves, and Michael Saylor is the exact same way about Bitcoin. It's digital real estate in Manhattan in the future and da 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 da. But when nobody ever pushes back on things that like make sense, it blows my mind. Nobody ever pushes back on stuff, even if you agree with them completely. I love crypto. I have a crypto channel that's about crypto and technical analysis and cryptocurrencies. But I do technical analysis, and I'm not brain dead culty. If you look at what's the main argue against Bitcoin or against gold from Bitcoin people and Michael Saylor, he's like, well, the problem is that as the price of gold goes up, more people mine it, and then more supply comes online, and then, you know, that's bearish. So there's bearish headwinds from gold miners, and they just make more gold. They don't make more gold out of thin air. They mine it because that's what they do. It's literally what Bitcoin is designed to do as well. The higher the price goes, the more people buy mining machines and the more people mine Bitcoin. And he's like, yeah, but there's a fixed supply of Bitcoin. There's not a fixed supply of gold. Are you sure? You think we just keep digging holes and there's just more gold and there's just never going to run out of gold? Like, are you retarded? The only difference is there's a computer code that says there's 21 million Bitcoin. There's a physical reality code. You would think that, you know, rocket scientists like Michael Saylor would understand there's only so much gold. Just because we don't have a 100% for sure piece of paper or piece of code that says there's this much gold total doesn't mean that there's infinite amounts of gold. We don't just poop out gold when the price goes up. You dig it up from the ground, from the limited supply of gold. It's literally what Bitcoin is based on. And he always talks about that as if it's not a thing. He's like, well, they'll just mine more gold. Bitcoin has a finite supply. Gold has a finite supply too. Michael Saylor is a retard. Like, it blows my freaking mind when I hear this bullshit and nobody pushes back on it because they don't understand, what's happening. It's so crazy. So crazy. Yeah, oh, 100%, dude. It's like, it's a marketing. It's marketing. I don't blame the dude. He's running a marketing campaign for something that he's invested in or that he's purchased. They call it talking your books, in Wall Street or whatever. You buy a bunch of something and you talk about how great it is. Because if the price of it goes up, you benefit. Your company benefits because they're holding a bunch of it. You benefit because you're holding a bunch of it. You're talking your book. You're like, oh yeah, I love pot stocks. They're great. Pot stocks to the moon. Like, but I have a ton of pot stocks. Like, oh, I'm no vested interest in saying that, I'm sure. I'm not saying me specifically, but, it just blows my mind. People are just so stupid. They just buy into this. He's like, because he's smooth, good talker or whatever. When I see Michael Saylor, all I can think of is 2000 .com bubble burst, scammer, got in trouble with the SEC, paid millions of dollars not to go to prison. That's what I see when I see Michael Saylor. Other people are like, oh, I don't know anything about that, and I don't care because he likes the same thing I like. You're like, oh, okay, careful. Yeah, now you can do the 10-year on your own, and you can mess around with, if you look at that Fred data, and you can see exactly where the recessions are, put in the dates of when they started, when they stopped. You can put in arrows where all that is, all those different things. It's pretty simple. You can draw it however you want. You can use regular candlesticks. You can use a line chart. I just try to make it look a little more pretty. Or you can look at, they have like the yield curve spread, and you can just put that up, and it just tells you, it's just one line, and tells you, what the spread is. Instead of telling you what the 2 is and what the 10 is and showing them closing in on each other, it just shows the spread. And when the spread is, 0 or negative, they've inverted, obviously. So, and you can do it for any time frame. You could look at the 30 and the 20. You could look at the, 2 and the 5, the 5 and the 10. Doesn't matter. You can put them all up there at once if you want and see how they're all like kind of converging on each other. But yeah, I think that's going to do it for today. Hopefully you guys enjoyed the stream going into the weekend. Should be a good one. I'm sure the world will be crazy. We'll continue to see craziness in the crypto markets. Obviously, traditional markets will be closed. We'll see how these closes look. Bitcoin on the 4-hour was starting to look bullish there, reclaimed the 200 exponential on simple. Got slow back to the upside. And now we have officially on futures and Bitcoin spot markets broken back down below 200 exponential and simple. The 4-hour 821 has crossed back to the downside. We're seeing a lot of bearishness in the crypto markets. So, that scalp trade has basically played out. So, thanks for covering HNT and sharing the knowledge. Appreciate you for sure, brother, of course. Always glad to share the knowledge. That's what these streams are all about. Thank you to each and every one of the group members for showing your support, as you are the ones that make these streams possible. And just a reminder, you can reach out to me about the group if you want, but the group is closed for now until further notice. You can put your name on the list, but I don't know when I'm going to have new members. I had more members come in than I was expecting. As soon as I said the group was closed, a couple of people that I had already spoken to that I hadn't heard from a while, all of a sudden were ready to go. And because I had already told them they could join, I honored that. So I've more people in the group now than I wanted in the group, which is cool. I like everybody. Group's great. But for right now, closed. No more group members. You can get on the waiting list, but I don't know when that's going to be. So that's fine for now. I'll let you know. But in the meantime, I appreciate each and every one of you. In the future, I will open that back up, as I know there are people that want access to the indicators. Obviously, as one of the perks, you get access to the TJD Master and also the Jewel Thief. You can also get a bunch of my other indicators that are publicly, published for free. So if you just go down to the description of the video, they are all listed down below there. There are similar indicators, previous version of the Jewel. We have the TJD, TDMACD. We have a bunch of other moving average indicators and other various ones as well. So you can still get access to all that in the meantime until that is not a thing, or it is a thing, depending on how you look at it. But that is it for today, Friday stream. Hopefully you guys enjoyed it today. I appreciate each and every one of you. Thanks for tuning in. Make sure you smash up the like button, share with your friends, and check us out every Sunday and every Wednesday from 8 p.m. Eastern Standard Time till about 10 p.m. Eastern Standard Time, and then Friday mornings from 11 a.m. Eastern Standard Time till about 1 or so p.m. Eastern Standard Time. Peter says, love you and your streams. Don't stop. Don't stop. Of course, I will not stop. I will be streaming for sure, my man. I appreciate each and every one of you. Love yourselves. Love your family. Love your community. Take care of yourselves. Project your principal, your capital. Don't lose your money at uncertain times. There's tons and tons of times when markets are going to be going up, and there will be easy money to be made. Don't get greedy now when there's so much uncertainty. Got to be careful with all this. Obviously, none of this is financial advice. I'm not your financial advisor. Please do your own research. Trade responsibly. Love each and every one of you, and appreciate you all coming, showing up, trading, participating, being part of the group, being part of the streams, being part of the community. Appreciate you too, Milligan. Good to see you, brother. He says, thanks a lot, Crypto Trend Trader. Great stream. Yes, thank you, brother. Appreciate you as well. So that's it for today. Friday evening market, Friday afternoon market wrap up. Going into the weekend, obviously going to be some more craziness, geopolitical events, crypto movements, etc. Stock market getting ready to close. Most of these stocks are closing at, year lows, lows of 2022 or near the lows of 2022. Does not look good. I don't know what has happened in the last 2 hours, but a little bit of buying coming in towards the end of the day. But, we're just consistently just putting in lower highs and lower lows. So a couple hours left. Who knows what's going to happen? Hopefully a aggressive close coming in, people buying it up, and then maybe we can have a decent bit of follow through on Monday. But more likely than not, just more uncertainty. More I'm buying the dip, I'm selling the rip. Like, just nobody knows what's going to happen. We got options, driving a lot of this market movements. So overall, going to be crazy. I'm sure it will be an exciting weekend. I'm sure crypto will try to do something. What it tries to do, I don't know, but more likely than not, futures and spot markets will be back in line by the time we come into Monday. But that is it for today. Appreciate you guys. I'm going to get out of here. Crypto Trend Trader with our Friday market wrap up. It is 1:30 p.m. Eastern Standard Time on March 4th, 2022. Appreciate each and every one of you. Crypto Trend Trader, and I'm out of here.